To office, as Joe was telling us, increasingly important. We'll look for some downside on TUI, perhaps as an investor is selling some of its stake there at a bit of a discount. So there are some individual stocks to focus on then, Guy.
Absolutely. Some of the single stock stories are going to be interesting. The overall top-down picture looks fairly negative at the get-go here in Europe this Tuesday morning. So here we go. Here it is, the opening trade. Let's talk a little bit about where these markets are going. We're expecting the initial FTSE 100 reaction to be to the downside, and that's what we're seeing. But not down by much. We're down by 0.2%. We're expecting maybe a little bit more on the downside for the FTSE 100, where we have seen people maybe edging back towards a more neutral positioning around the FTSE 100. I'm waiting once again, though, to see how the CAC opens this morning. You've got the DAX down by a little bit. You've got the IBEX down by a little bit more. The IBEX looks like it's actually under a little bit more pressure, down by 0.8%. And there you go. There's the CAC 40 down by 0.6%. So as anticipated, despite what we saw yesterday in the United States with the tech rally that drove the afternoon session, we are seeing a negative picture developing here in Europe. Critty, the key question is, which stocks are driving it?
Well, all of them, to be completely honest, on the French side of things. I'm actually looking at which stocks aren't lower, and that really seems to be the energy story driving the story higher, at least, Anna, for the French index. Total, for example, making up about 9% to the upside in terms of index contribution, but it is a broadly lower day, as Guy was just talking about, and that's something that's feeding into the stock 600 as well, where you do see the energy story, again, the outperformer for a second day in a row.
Absolutely. So energy is one of only two sectors going higher. The other is technology, and that's kind of borderline, but energy stocks up by 0.4%. We talked about the higher oil price a little earlier in the program. 86.82 is where we trade on Brent. It's only 0.25% higher than the close of yesterday, but there do seem to be these upside forces to keep an eye on. One of them is Hurricane Beryl, of course. We've talked about how unusual it is to see a hurricane as strong as Beryl is this early in the hurricane season. So that seems to be putting some upward pressure on prices. But we also have tensions in the Middle East, and I know there's been news flow surrounding Hezbollah overnight, and so all of that adding up to a slightly higher oil price, which means if you're looking for anywhere to hide out, then energy stocks perhaps seem to be the place to be. Maybe especially if inflation is backed in your thinking, if you're thinking about a Trump presidency and whether that's more likely, and you're thinking about inflation and places to hide from that, maybe energy stocks get a bid as a result of that too.
Or you just kind of are slightly concerned, to Critty's point earlier on about NVIDIA. Where do you go? If you are going to shift out of some of the growth stocks, and technology had a great run yesterday, do you go into the energy space? Is that one of the most logical trades that you can make if you want to maybe top size your portfolio and take some of the profits out of that AI trade? Technology was strong yesterday. This could just be a tactical repositioning.
I mean, and if you're talking about a read-through here, ASML is your biggest index contributor, again, to the upside on stock 600, in line with the energy story. So you're seeing your BPs, your Shells, your Totals, and then ASML is kind of thrown in there alongside Novo Nordisk. So it is a cyclical story in some ways, but it's also kind of a defensive one. It feels like this is a large cap versus small cap, almost, or medium cap maybe, kind of story where the large caps are actively performing better. I don't have the answer to that question.
We had a guest on last week, didn't we? It was all about the catch-up trade for small caps and saying this is, that's another way to cut the US equity space. And for him, that was the missing part. Looking at other things that are moving to the downside, and of course, we had a lot of focus on French stocks yesterday. Autos and auto parts is the worst performing sector, and Michelin is the worst performing stock within that. That's down by nearly 5% today. Looking at construction and materials, that was another one that did well yesterday out of Vinci and others going higher. There's not a sort of obvious French move lower in that one, but certainly we are seeing a little bit of unwind in some of those trades of yesterday around the French election.
Can I just point out Spain lower today? Quite a lot lower. Down by
that.
0.8%. If you're going to wear the hat, you got to.
Me and the entire country of Spain appreciate it. Me, Enrique Iglesias, and the entire country of Spain appreciate that. We'll circle back to the Spanish story, but it still feels like France is going to be the center of attention. And we're really talking then about not just the geopolitical turmoil, but the economic data as well. Take a listen to what Philip Lane had to say.
And the key issue there is really services inflation. And what we've seen in the last day is essentially services inflation remaining the outlier. It remains relatively elevated. And what we need to see is that relatively high services inflation just a backward element. It's a legacy of the rapid disinflation that it's still working its way through services inflation, or is there any persistent element? And I think right now we need to take a little bit of time to work on that.
ECB Chief Economist Philip Lane. They're speaking exclusively to Bloomberg's Francine Locke at the Central Bank's Sintra Forum over in Portugal. We're joined now by Bonnie Boweja, Chief Strategist over at UBS. Thank you so much for joining us this morning. What do you make of this? We're seeing a little bit of relief, perhaps, in the equity market this morning. What do you attribute to that to? Is that just steam out of this market, or is that a geopolitical overhang?
Look, I think the market is basically saying that the election results were not very different from what they were expecting, right? So there's a little bit of political relief. But I don't think there's a lot of risk premium in the market. I don't think French spreads trade that far above bonds. I don't think there's a lot of risk premium in the euro, and I don't think there's a lot of risk premium in France. So I don't expect that this relief rally will go that far. I think this is going to be quite limited. Medium term, you're a little more worried that this kind of political uncertainty is going to make for slightly lower growth relative to the counterfactual. Yeah. And that should also mean for slightly weaker earnings growth than would have otherwise been thought. So I can't see this very positively. I mean, I think this is a modest relief rally. This is not something that we want to be chasing particularly in front. There's some sectors in Europe that are cheap and would continue to do perhaps quite well. I think banks can continue to do quite well. Credit, for these banks has really not done that much because, in fact, their capital structures are very robust. It's very different from the way Europe was in the last 15 years. So I think that's where you'd probably want to be fading any losses, except there aren't much losses, right? So as I said, there's very little risk premium in the market, geopolitical risk premium as well.
So how much of the equity story then is really still connected to the bond market story? Over in the States, it feels like they've kind of decorrelated for a little bit. How much of the cross-asset story is still relevant here?
Well, the bond-equity correlation remains quite positive for now. I think that will change, and I think the one thing that will change it is lower inflation. As inflation comes lower, I think you will probably see as core inflation begins to settle below 2.5, 2.6%. That's usually the threshold, the Rubicon, below which bond-equity correlation goes negative, and we've crossed that, and I think if we settle down here, which I think we will, bond-equity correlation will go negative, and bonds will become a diversifier in portfolios again. But you're absolutely right, Kriti, to point out that if you look at the U.S., I mean, yesterday the bond curve bear steepened, as in the long end sold off quite aggressively, especially 10s 30s, so the very long end sold off even more. And despite that, equities did well, and equity volatility was very low. And I don't think that will continue. I think the market is looking to play sort of a Trump victory in exactly the same way as it did in 2016, thinking that it's going to be quite positive for equities, except if the bond market is less forgiving this time, I think the equity market will also feel it. So I think equities are more wrong in this case than bonds are.
We asked this earlier, is the right trade for a Trump presidency a steeper curve?
It should be a steeper curve. That's definitely the case. Of course, life's never easy, which is to say that at this minute, U.S. inflation is coming lower and the Fed is staying put. The Fed is not cutting rates. That makes for a flatter curve, but I think the steeper curve over the next 6 months is absolutely the right trade. We should also think about the break-even trade, which is the inflation trade, because what's really strange about the fixed income markets is that inflation has come off quite a long way, but real yields have not. Right? Yep. So inflation break-evens really have come off. So the reason why nominal yields are quite high is because real yields are high. So contrary to the narrative where everybody is worried about inflation being sticky or the last mile, in fact, the break-even market tells you that inflation's not sticky. They've taken down 5-year inflation, 2-year inflation. Now, I think that's probably gone too far. And if you're thinking about, a Trump tariffs, 10% on all imports, 60% on imports from China, that could actually lead to slightly higher inflation.
As if they're listening to the programme, Banu, the ECB's Muller says there are risks of underestimating price stickiness. You were talking in the US, but there was also a global reference in there as well.
There is.
So why are you so convinced then that prices are not sticky when we keep hearing that from various officials?
Oh, for the simple reason that growth is slowing down, right? And much more so in the US than in Europe. In Europe, growth is, if you look under the microscope, improving, right? I mean, it's a very small improvement and from a very low level, but growth in Europe is improving, right? And also because real wages, I think what we really need to understand is that real wages are in different states in many different regions. In the US, they'd already peaked about a year back and are back down close to zero. Real wage growth in the US is back down close to zero, whereas in Europe is much higher. In Japan, it's just about beginning to go. So very desynchronized cycles. We're not used to this, right? In pre-COVID, what happens to China today happens to the rest of the world tomorrow. These cycles have become completely desynchronized, and real wages in the US have come off, and that's why consumption in the US is palpably slowing down. And this is why I think inflation is also going to come lower. And I think that's the main story. Geopolitics is very interesting, and we'll talk about that throughout this year. I'm sure we'll talk about the election, but I think one of the main stories is lower US inflation through the summer. And even the next print, the last two prints were below consensus. I think the next print is also going to be 17 basis points. Now, the point is that the fixed income markets and break-evens are pricing a lot of this in. So if there's a surprise from politics, from geopolitics because of higher tariffs, I think that would be lower real yields, higher inflation.
Can I just come back to the difference you flagged just a moment ago between the differing reaction yesterday? So you get one reaction in the bond market, one reaction in the equity market. It was technology stocks that drove us yesterday once again, and the debate. The technology sector just feels so different, and it's having such a big effect on the equity market that the equity market, in some ways, is not responding in the way that you would normally expect it to do. How much longer does that continue for? And I'm not going to ask you to name individual names here, but do I want to have in my portfolio, am I going to get much more out of my portfolio, high multiple, AI-powered, and I'm not naming names here, stocks?
I think that we're probably in the latter stages of that trade. So, for instance, within this Magnificent Seven, we're not chasing 5 of them, right?
Yeah.
I think we're in
the latter stages last how long?
The latter stages last probably about 3 months, if that. And this is also because technology stocks are sensitive to interest rates, and we think that the front-end interest rates will come lower, in line with lower inflation. I think the Fed narrative around September could change dramatically. I think the Fed has been extremely hawkish in the face of a slowing economy, looking at real yields of...
They cut in September.
Well, I think there's a high likelihood that they cut in September, but there's a greater likelihood that what the market is priced for 2025 is much too low. So the narrative of the Fed, I think, will change right now. The 2-year yields will come lower. That can push technology stocks higher, but we're looking at 56, 50 for the S&P. From there, I think, so from there, you'll see the S&P very likely coming lower. So 1 step higher because of lower inflation, 2 steps back because of weaker growth.
Isn't that positive? So why not chase all those Magnificent Seven then, if you expect that the market is wrong about September, or the market is underpricing a September cut?
Because in some of these cases, valuations have gone too far. And we are chasing tech more broadly, partly in the US, but also in Korea, Taiwan, Japan, China. So we are chasing tech quite broadly because tech, not just the Magnificent Seven companies, but all of tech should benefit from slightly lower yields. It really shows up as one of those sectors, along with real estate, along with the utilities, that really benefit from lower yields. But some of these have gone far too much, and the earnings momentum is shifting in these cases, and that's why we're not chasing.
You talked about desynchronization earlier on, Banu. It sounds like that there are real reasons then to expect the Eurozone to be on a different course to the Fed, although you expect the Fed to cut quite soon, so not for all that long. But you're not too worried then about sort of desynchronized monetary policy as we see it right now?
They're not going to go in completely different directions.
No.
Japan being an exception, of course. They're not going to go in completely different directions. But I think ECB is right to go slow. I think the Fed will probably have to go much harder. Once it begins to go, the Fed will have to go much harder. So I think the Fed is much more mispriced than the ECB is. ECB, 3 cuts this year, 3 cuts next year, steady as she goes, with real wages being reasonably high. I think this is why we're not going to get much from Lagarde in terms of forward guidance. The ECB is going to go quite slow. I don't think it's going to be it's going to move step for step with the Fed at all.
When we had this conversation in 6 months, in terms of what this back half of the year has looked like, how much of it will be largely a function of capital flows, of liquidity, of a defensive bid into the states more than anything else?
I think the last point is probable. I think you will probably see a defensive bid in the States because growth is downshifting, right? And it could be about capital flows, but if it is about capital flows, then essentially you're saying the market is totally a momentum-based market. And a momentum-based market is one where you're chasing Magnificent Seven. We are chasing only tech for the next 6 months. I don't think that's likely. I think Magnificent Seven, that trade is quite mature, at least from a tactical perspective. Of course, these are great companies. That's why, hence the adjective magnificent. So over the medium term, they will do quite well. But there are different phases where they slow down and perhaps there's a tactical correction. I think that is likely. I think the sort of the central pillar of how the markets are likely to trade over the next 6 months, I think, is lower inflation first in the US, followed by lower growth in the US. So Europe and China will improve smalls, but US is coming lower. Okay,
let's wrap this all up in a nice neat bow. So we've got sort of nicely. Yeah, we'll try and do that. Inflation's coming down, political risk is there, stock markets have run quite a long way. Probably got a little bit more, but maybe they fade after that. So in aggregate, the nice little bow, am I risk on or am I risk off?
You are risk off in equities, right?
Broadly, so I'm risk off. That because I don't hear this from a lot of portfolio managers right now. What I hear is risk on. So, but your sense would be, I want to be, that mentality has to change. I need to go risk off.
Over a 6-month period, lower growth will be the bigger issue rather than lower inflation. So lower inflation today keeps you risk on for a month or two. Yeah. Lower growth compromises risk over a 6-month period, and perhaps more so than inflation will help it in the near term.
What gets these portfolio managers there? What's the moment?
I hate to say it, but price itself. Many folks chase momentum. Momentum has been a very successful strategy, and as the markets begin to consolidate, as you find that I'm getting more coupon, then I'm getting capital gains. I mean, you folks earlier in the program were speaking about small caps and the equal weighted S&P. The equal weighted S&P has done very little. So 493 stocks have done very little, and everyone's chasing just that section of 7 stocks. And I think that's getting long in the tooth, as I said to you earlier.
Nice to see you. Always a pleasure. Barnab Wager joining us from UBS, Chief Strategist over at UBS. Quick look at the big stocks out of Europe, the core 6. This is what they look like this morning. This is the picture we are watching. More of a mixed trade. You can see some tech maybe feeding off what we saw in the States yesterday. The growth narrative maybe still evidence with Novo Nordisk also tracking higher. The rest of the market feels like it's a little bit more defensive this morning. Not going anywhere in a hurry. There's a lot to digest for the rest of the week. Let's talk about some of the single stock stories we really need to be focusing on this morning. Joe Easton has the details.
So we are seeing small declines in the 2 big companies that gave sales updates today. Sainsbury's and Sodexo both declining. Sainsbury's looks like their growth is actually slowing quite significantly. They were talking in the statement around gaining market share, but when you look at the numbers, sales growth of around 3%, down from around 10% at the peak of the food inflation crisis. So that does seem to be weighing on the outlook, alongside that weakness in the smaller Argos business as well. Sodexo, meanwhile, only very slightly below estimates in terms of the revenue, but that stock has had a good run this year, so potentially giving up some of those gains. We brought up some read-across stocks as well. Tesco for Sainsbury's, and Compass, the big rival to Sodexo, those ones declining very slightly as well today. Then in terms of the deals, that big mover over in Germany, it's Northern Data, probably best known for its Bitcoin mining business, but as you were discussing earlier, potentially looking to list its AI business in the US with a valuation of around $16 billion at the high end. Now, bear in mind, this is a company with a market cap of less than 2 billion euros, so that is really showing it could potentially unlock some value there. Carrefour, we've had an update from them on some brands they're buying in the French region, the Match brand being one of them. They've actually upgraded some of those synergy targets, not seen too much movement there. And Tritax Eurobox, this is in the commercial real estate in the UK. They have got some offers coming in from Blackstone in private equity, according to a statement last night. In terms of TUI, we had that discounted share placing coming in overnight. There was around 7 million shares of the company, so we're seeing that one slipping today, down 3.5% as investors price that one in. Then we'll take a quick look at the oil stocks. You did already cover those. We've seen oil gaining at 2% since yesterday's close, partly due to news of that hurricane coming in in the overnight news flow as well. A bit of a movement in some of those stocks this morning. One stock we haven't covered is Michelin. Now, traders telling us that the company held a pre-close call with analysts last night, and they are looking pretty soft on some of the volumes for the French tyre company, according to the analyst reports coming in at the moment as well. So we're seeing that one declining 4.2% this morning. Couple of morning calls to bring you back in the AI theme. This one, Teleperformance, gets an upgrade. This is the call center company, also in France. Morgan Stanley actually saying the AI risk for call centers is actually overdone. They reckon you should be buying into that theme. And finally, a very rare upgrade for Siemens Energy. This one coming in from Redburn. We've had a lot of issues with their wind turbines, but Redburn reckons that's overdone. And take a look at that price target, 42 euros. It's only trading at 25. It's the highest price target on the street for Siemens Energy, and we're up 3% in Germany for that one.
Joe, thanks very much. Joe Easton from our equities team with a look at some of the stocks on the move. We'll continue the markets conversation next. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back to the opening trade, 22 minutes into our European trading session, and the opening trades are pretty negative, and we continue in that fashion, down by around 0.6% on the Stoxx 600. Let's talk about where we are on these markets. Ven Ram joins us from the Markets Live team for 3 minutes on the markets. Ven, let's talk about euro area inflation. We're waiting for that data in a couple of hours' time, and I wonder what difference that's going to make to the markets, actually, because I think we're expecting it to come down from 2.6 to 2.5%. I mean, it's moving in the right direction from the ECB's perspective, but not a huge achievement. How much of a market mover can this data point be?
It's not going to be very much of a market mover. It's certainly not going to move the dial very much on front-end German yields because, as you mentioned, we are expected to get a 2.5% reading. But more importantly, if you look at core inflation, it's supposed to be coming in at 2.8%. If the forecasts are right, that will make core inflation closer to 3% than 2%. So the ECB is not going to be very convinced that the inflation goal has been conquered. We had Philip Lane comment on Bloomberg TV just earlier on that, look, the HICP gauge doesn't do it for services inflation, and they need to see the contours of not only services inflation, core inflation, but also wage pressure, wage inflation. And they won't have the data, crucial set of wage data, before the September meeting. So we are not going to get any chance of a rate cut in July. Even in September, a lot depends on what that kind of data is going to show. So in short, there is not much of an incentive for either German yields to move lower or for the markets to price in more cuts than they're expecting. At the moment, the markets are thinking like 40 basis points of rate cuts from the ECB in the remainder of the year. I remain skeptical. I think that one rate cut in the remainder of the year is more like it.
Ven, should I make any big trades in European government bonds until I know the outcome of the French election?
Well, I think that, the risk-reward equation has changed, Guy, in favor of French bonds. Let me explain why. If you look at the yield spread on France to Germany, it's bobbing around 80 basis points, say 75 at the moment. But look, where do we go on France in the risk spectrum from here? There are only two possible scenarios from here looking likely. One is that Le Pen gains a majority, in which case the markets won't like it. But Le Pen has already said that, look, they're not going to be spending a whole lot. They are mindful of what is going on with investor reaction. The other side of the equation is a hung parliament, which will also rein in excesses in terms of fiscal spending. So if you look at the risk-reward equation, France is a AA- rating, and the worst it can get to is an A handle. And if you look at, which is the rating that Spain has currently. So if you look at Spain over France yield, that makes more of a sense, and there the spread is only 10 basis points in favor of Spain. In other words, markets are already thinking that France is trading like Spain. So come another 10 basis points, France would start to look increasingly like a bargain, and that's what investors should focus on.
All right, Ben Rom from our MLive team, we thank you so much walking us through some of the dynamics in the bond market as a result of geopolitics. We thank you so much. Remember, you can get more up-to-date analysis and insight from Ben and the rest of the team. Just type in MLIV Go on your Bloomberg terminal. So Ben walked us through the geopolitics and the trade going into the bond market, but there's still some inflation data that we got to give some love to.
Well, I think it's really interesting that he thinks that the center is down the periphery when it comes to bond markets.
Yeah, it does seem like a little bit of role reversal in terms of what is happening here. The concern, of course, is that if the center, the periphery was manageable, you could call, I can't remember who wrote this earlier on one of the live blogs, you could call Greece's bluff and kind of force it to do what you wanted to do. You can't call France's bluff. France is too big, too important. If there's a problem at the center, it is a different order of magnitude to having a problem at the periphery.
Yeah, so there are limits to how much the core is the periphery then. Yeah.
But speaking of those limits, isn't this the conversation around the ECB? Do they have to intervene because of that importance? That, at least was a conversation I felt like in Europe over the weekend and going into next weekend as well.
Where is the line for the ECB to get scared? We're going to ask that question to our next guest. Jean-Claude Trichet, former ECB president, is going to be giving us his take on what is happening with the French election. Would he take part in a technocratic government? We'll ask that question as well. This is Bloomberg.
News and Tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It remains a very, let's say, undecisive outcome ahead of next weekend.
The situation in France is very difficult, so you have a choice between hang parliament and far-right government. So neither of them sound particularly appealing.
Maybe you block a majority by the hard right, but in the best case scenario, you get a hung parliament that effectively means very little decision making, no ability to deal with a very wide budget deficit.
The cancelling of the pension reform, it's economically and financially, it's a madness.
But being careful what you wish for, because obviously in the longer term, if we have a very strong leftist influence on the French government, what that means for France as a business location probably isn't going to go down very well with the markets at all.
Our guests giving their opinion on what we're seeing in France and what impact it could have on the markets. We're done with the first round. We're waiting for the second round. What kind of risks do we need to think about here? What kind of a risk has this snap poll created for France and for Europe? There is a great voice to speak to on this subject, and that is Jean-Claude Trichet. He joins us now, former ECB president. Jean-Claude, a pleasure. Thank you very much indeed for your time this morning. Give us your assessment of the risk that this French election has created for France and for Europe.
It's a real pleasure to be with you. Of course, the risks are very big. I would say, to caricature, if either the program of the extreme right or the program of the left extreme would be applied, it would be extremely bad for France, for the French citizens, and of course also for Europe, taking into account the position of France. The relatively good news is that this absolute majority for either the right extreme or the left extreme seems to me to be improbable, unlikely at the moment I'm speaking, but we are in a large, I would say, environment of uncertainty, so nothing would be really said with some, I would say, pertinence before the second round, clearly.
As you suggest, it does seem as if some of the tail risks are becoming less likely. The extremes are becoming less likely. However, that does leave us with the potential for a hung parliament at the National Assembly. And I'm wondering at that point whether or not you think a technocratic government could be formed in France, whether you'd be willing to be part of that technocratic government if asked to serve upon it, and if not, what advice you would give to it.
Well, first of all, I think that a technocratic government is not in the French tradition at all. It might be a solution in other countries, namely Italy. In Italy, the governor of the central bank is regularly, if I may, Prime Minister or even President of the Republic. I have known several Presidents of the Republic or Prime Minister that were previously Governor of Central Bank. In France, it is not the case because we are in a totally different, I would say, political framework. So what I would expect in case there is no absolute majority by either political sensitivity and in case there is a solid block of the center that would represent a minority, of course, of the hung parliament, but a substantial minority in the hung parliament, I think that the president would probably try to have a coalition government in having the center, the so-called social democrats on the left side, plus others, perhaps the Green, and on the right side of the political spectrum, the so-called Republicans. And that would perhaps permit to have a coalition government.
Okay, just on the technocratic government front, Christine Lagarde has got a great job right now. You know it's a great job. Do you think there's any chance that she could be persuaded to enter politics in France?
Well, as you know, Christine Lagarde is a totally different case because she was managing director of the IMF. She is president of the ECB, but she was also member of a government. She occupied several positions in a French government. So she is not, if I may, totally out of politics. She exerted political responsibility. So if she would be convinced to get back to the French government, I think it is a possibility. But again, it seems nevertheless to me quite unlikely because you have a number of positions that will, in that assumption, be occupied by many political men and women that are belonging to the three, I would say, political constituencies I have been mentioning, namely Republican left, if I may, Republican right, and the center, the large center.
Okay, so we'll see where her career takes her. In her current role, Jean-Claude, she is obviously in charge of the ECB, and we'll see what happens in markets, but there's a chance that the ECB is called on to act in this French election, in the sense that we could see something disorderly in bond markets. Now, the ECB at the moment says that's not what we've seen. And if we did see something disorderly, perhaps they'd have to use the TPI, the Transmission Protection Instrument. What conditions would be attached to using that, do you think, Jean-Claude? Because clearly some in Germany would be concerned.
Well, I would say first, it is not my working assumption at all. And experience has demonstrated to me that if you enter in an assumption, which is more or less a dramatic assumption, when it is not at all likely, you're doing a poor job. So I don't embark on such a meditation. At the present moment, it seems to me that the market have been reassured to see that it was very unlikely that any of the program that had been floated would be implemented because there would not be an absolute majority for either, I would say, side. And that being said, I expect, of course, I hope, I am biased, there is no doubt, that what will proceed out of the hung parliament would not be dramatic, would not hurt the market sentiment and would permit, I would say, France to go on in a situation which would be politically totally different, of course, but not at all hampering the creditworthiness of the country.
Okay, so that's interesting, Jean-Claude Trichet. So you think whatever government is formed, you think that the bond market should be satisfied and we won't see any kind of credit rating downgrade?
Well, again, this is my working assumption. And as I said, we are living in a time of high uncertainty. The second round, two-round election process is very uncertain because you don't know at this stage what the voters, what the fellow citizens would do exactly. They got recommendations by the leadership of the various political constituencies, but will they apply by the suggestions which are made is another story. So I think that we have to remain very cautious and prudent. It's clear that we might be surprised after the second round. At this stage, taking into account my own understanding of the situation, I'm not making the working assumption that the result of the second round could hamper gravely the creditworthiness of the country.
Jean-Claude, it's Creedy in London. We talked a little bit about the deficit and the stock market the last time you joined this program. Your worries around the deficit have clearly come true, especially when it comes to the French bond market and arguably the U.S. one as well. I'm curious about your thoughts about the stock market. Last time you were here a couple of months ago, you talked about how worried you are about the rally, specifically in the U.S. stock market. Your thoughts now?
Well, I'm very worrying, obviously, and still be, because at the global level, of course, I'm not speaking of France in particular, but at the global level, I see a drive up of the stock market, which seems to me over-exaggerated. And it seems to me true in the US, in Europe, to a lesser extent, perhaps, and also in the rest of the world. So we will see what happens. I have experience in my own past, professional past, situation of that kind, where you have something which looks like abnormal behavior of markets. In the long run, they are always right, as we all know, of course. But in the the short term, they can be a little bit out of the fundamentals. We will see again. I don't want to be a Cassandra, but it seems to me that some kind of correction on the stock market will materialize at a certain moment. And again, I'm speaking of all stock markets, US and the others.
Yeah. Well, speaking of the U.S., the last 48, 72 hours have been quite tumultuous on the U.S. political scene as well. Jean-Claude, I'm curious about how worried you are about what the next 6 months in U.S. politics, whether it's a Trump 2.0 or a Biden 2.0, may look like for the future of Europe going into 2025.
It is absolutely clear that we have an enormous influence of the U.S., of course, but of the U.S. administration on Europe, to the extent that we are experiencing a big war in Europe for the first time since World War II, I have to say. We are experiencing a shaky U.S. backing. We could hear what President Trump said in the past. We expect that if he's again to the helm of the U.S., we can have very bad surprises in terms of position vis-à-vis Russia, in terms of position vis-à-vis the, I would say, support, strategic support of the U.S. So this is, of course, something which we looked at very, very carefully. I cannot hide that I am myself afraid of what could happen, and many Europeans are also afraid. Anyway, it gives an additional argument for the traditional French view that in any case, in the medium and long run, we have to rely on our own might. We have to rely on our own strength. And I'm speaking, of course, not only of France, but of the whole Europe.
Jean-Claude Trichet, thank you very much for joining us this morning. Former EC president, of course, joining us there from Paris. We go back now to the ECB forum in Sintra, Portugal, where central bankers from around the world are discussing the role of monetary policy. We've talked a lot about the ECB. We need to talk about the Fed. Bloomberg's Francine Lacroix is there. Fran.
Yeah, we need to talk about monetary policy worldwide. You're absolutely right. And joining us now is Austin Goolsbee, president of the Chicago Federal Reserve. And I welcome, of course, our radio listeners and our TV viewers as well. Thank you so much for joining us. There's a lot going on in the world right now, and the focus is firmly, of course, on Europe, but more importantly, on the Fed. Now, there are a number of outside economists, including Mohamed El-Erian, that have suggested that the Fed should get on with cutting interest rates. And this is risk perception. Is there too much danger in waiting for too long to cut?
Look, there's a danger from waiting, and there's a danger from making wrong moves. The basic function of the central bank and what the Fed's got to decide is we move to a quite restrictive posture. We raise the rates a great deal in a short period of time, and we've been holding it there. We got to this rate when inflation was over 4%. And inflation's now down close to 2.5%. So if you sit with the rate somewhere while inflation goes down, you're tightening. And the reason that you would want to tighten is if you think you're not on path to 2%. If you're on path to 2%, you've got to take seriously that the U.S. central bank's got a dual mandate. So if employment starts falling apart or the economy begins to weaken, which you've seen some warning signs, you got to balance that off with how much progress you're making on the price front.
So how worried are you about the unemployment rate, but with the jobs slowing down? I mean,
It's still, the unemployment rate is still quite low, but it has been rising. And if you look at quit rates, if you look at the ratio of vacancies to the number of unemployed workers and various conventional measures of the job market, they're cooling, but they're at a level which is still pretty strong. That's kind of what we've been trying to fully sort out. Now, I think if you look at the second half of last year, in the U.S., we had 7 straight months of excellent inflation. We hit a bump in the road in January of this year, but now we've gotten a string of improved inflation readings. If we get more like what we have just seen, to me, that feels like the path to 2%.
But so, at what point would you want to cut rates to make sure that the unemployment number doesn't get worse? I mean, how do you calibrate that?
You need to calibrate that. That's the right way to say it. It's not a formula that says, hey, well, last month this is what happened, therefore let's change the monetary policy. You got to take it in totality. As I say, we've been restrictive. If you look at the real federal funds rate of just interest rate minus inflation, it's as high as it's been in decades. And the only reason that you would want to be that distinctively restrictive is if you think that the inflation is not coming back to 2%. If you get months that are like the second half of last year or like what we've seen now here for a bit of a string, then I feel we're on path to 2%, and you return, if that's returning to normal, the rate structure return to normal too.
So what does your June dot look like? Would you cut it?
I don't like tying our hands even partially. So it's going to depend on the data. It depends also on the composition. If you look at inflation, in the Fed's dual mandate, we've been doing great on the employment side, and we have done far less great on the inflation side. But now inflation is coming down, so we got to think about both sides. Within inflation, goods inflation has looked almost back to what it was pre-COVID. Services inflation improving, getting closer. And the thing that's been the toughest puzzle in the U.S. has been why housing inflation hasn't come down. The way they measure the inflation in Europe is different. By the European measure, the U.S. would already be at 2%, but we're still grappling with this housing issue.
But is it fair to, I mean, when I'm hearing you speak, is it fair that you would cut then sooner rather than later?
Well, like I say, I don't like tying our hand. We're still going to get a lot of data between now and the next meeting, and certainly between now and the rest of this year. But the question of how restrictive the Fed wants to be when we're at a pretty historically restrictive position depends on what happens to inflation. And if you just hold the rates where they are while inflation comes down, you're tightening. And so you should do that by decision, not by default.
When you look at unemployment, so it's around 4% at the moment. If it slows down a little bit more, is there a danger, if it actually rises a bit more, is there a danger that suddenly it kind of gets out of control?
There is a danger. Look, the historical business cycle pattern, as you know, is there's not slow deteriorations. What we have seen so far is very unusual. Usually, as they describe, unemployment goes up like a rocket and comes down like a feather. And so that's on everyone's mind, that there are some warning signs in the job market.
But is this time different, or is this a real concern of yours?
Probably some of both. I mean, I always say job of central bankers to be concerned and worried about everything. So we have to take that seriously. That said, the unemployment rate is still very low by historic terms. The job market is still quite strong. It's just been some warning signs. And as inflation comes down, we got to keep our eye on the other side of the mandate. If you remain restrictive for too long, that's going to be a problem.
I know you don't want to tie your hands into calling a cut or a when, but when the Fed starts cutting, is it going to be a cycle of cuts like we've seen in the past, or is this cycle different?
I mean, it depends what happens with the data. This has been a very unusual business cycle, recovery. Now in the job market, it looks unusual. So I don't like to predict for the next meeting, much less what would happen in multiple meetings after that. I just think we just have to see what happens.
But do you think the market needs to be guided? I mean, the markets have been all over the place in pricing cuts and then not cuts. I mean, some even looking at possible rate hikes.
Yeah, look, the market does what it does, and the central bank does what it does. And Paul Volcker was my mentor, and he had this phrase: "Our job is to act, and their job is to react, and let's not get the order mixed up." So the market, it's presumption. It's not for the central bank to give guidance to the market. The market is trying to figure it out. They have a tendency to run one way, run the other way, and you've seen that with the announcements of the summary of economic projections, for example. If the median dot says there will be 3 cuts last December, they say, well, that must mean 7 cuts, and then that volatility has a way of smoothing itself out as they learn about reality.
So it seems that a lot of the data is also politicized when you look at consumer sentiment. Because we're in an election year in the U.S., is it difficult to take? Are you confident that the consumer sentiment that you're seeing is the correct one? Because
not really. The Fed, the law, it orders the Fed to look at the actual numbers, employment and stabilization of prices. We've always used consumer sentiment and wanted to check that data because it was a good indicator of consumer spending. And part of call it politicization, whatever you want to call it, this real divergence in the consumer sentiment data is that it's become a horrible predictor of actual spending behavior. So I think that's, at least for me, that's made me a little cautious of concluding too much from what comes out of it.
So what does that mean, that you're putting more emphasis? We have a jobs report on Friday.
Yeah, I put a lot of emphasis on the jobs reports, on for sure all the measures of inflation, both the official measures, and we now have such a wide expanse of private sector information that we can get in real time about prices. And I'm in the Chicago district, it's the heart of the Midwest. We talk to business people, we talk to community leaders. We're trying to get real-time information. I put a lot of weight on that too.
Austin Goolsbee, thank you so much for joining us today. That was the president of the Federal Reserve Bank of Chicago. With that, Guy, back to you in London. We'll have plenty more from Portugal.
Francine, thank you very much indeed. Looking forward to the rest of the coverage coming out of Sintra. Austin Goolsbee says that the employment data is important. Maybe we all need to turn up to work on Friday. It's going to be a big day. Anyway, more on that next. Plenty more still to come from Sintra. This is Bloomberg.
my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing the World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back to the opening trade. 55 minutes into your European trading day, and stocks are weaker. We have plenty more voices coming through from Sintra this morning, including interviews with the SocGen chairman, Lorenzo Binismaghi. The EBRD chief economist joins us, Beata Javorcik, and the Bank of Portugal governor on home turf, Mario Centeno, will be speaking to the team as well. So plenty of interviews then, Chrissy, coming up in the hours ahead from Sintra, but it's not all about monetary policy.
It's not all about monetary policy. We're going to talk about defense as well. We're going to talk about U.S. politics as that story evolves as well. I'll be speaking to Julianne Smith, the U.S. ambassador to NATO. We're going to be talking about what that story actually looks like in Ukraine, what the funding story looks like, how they're potentially trying to protect Europe or not be able to protect Europe as the defense story in Europe ramps up at a slower pace than previously expected.
What would a Trump administration do to that story, I think, is a really interesting kind of exercise to try and figure out. 3% maybe the minimum. CPI data is coming up very shortly. I suspect that will play a bit of a part in the conversations in the corridors at Sintra, how that data gets digested.
2.6 to 2.5%. This is what dreams are made of.
What does services inflation look like?
Yes, you're absolutely right. That's going to be a focus, especially given what we heard from Philip Lane. That he's already told us that whatever it says, it's not going to be the answer to all their prayers around bringing inflation down.
Weakness in the euro as we count down to that 107.18 on euro dollar right now, 126.25 on cable. So that does it for the opening trade. The pulse is up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Sintra for the ECB Forum. Now, we have a range of top interviews this hour, including the Bank of Portugal Governor Mário Centeno, the Apollo Chief Economist Torsten Slok, Chief Economist of the EBRD Beata Javorgin. But we start, of course, with the Société Générale Chairman in just a second. Now, let's also take a look at the European markets map because, frankly, markets have been, if not wild, certainly interesting. Now, European stocks are actually declining. We do have a bit of Euro region inflation data coming. And this is after policymakers seem to be signaling that they need more evidence that price pressures are easing before considering another interest rate cut. We also spoke to Philip Lane, the chief economist of the ECB. Now, the president of the ECB, Christine Lagarde, says the bank does not yet have sufficient evidence that inflation threats have passed.
Facing several uncertainties regarding future inflation, especially in terms of how the nexus of profits, wages and productivity will evolve, and whether the economy will be hit by new supply-side shocks. And it will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed.
Now let's discuss all of this with Lorenzo Binismaghi. He's chairman of Société Générale and former ECB board member. Mr. Binismaghi, as always, thank you so much for giving us a little bit of your busy schedule here in Sintra. This week feels different because there's a lot of politics, and there's a lot of politics chatter outside the main conference center. But what does it mean for a bank like Société Générale, given the election drama in France? How are clients feeling?
Well, I mean, we have to wait for the election. Clearly, there's more uncertainty than 1 month ago. People are maybe waiting to see the result of the election. It's just one of the many elections this year. We have one later this year, which is maybe as important. I think this adds to the uncertainty, and we have to navigate through this and manage risks. And I think we're helping our clients to do that.
Are clients having more transactions ahead of the second round of the election, or has there been any change in their behavior?
What we see is increased volatility in the markets, and clearly this is to be expected, and we try to manage that. I think in terms of investment, of consumption, behavior of our customers, I think they're waiting to see what the outcome is. There are so many divergent possibilities that I think for them it's better to wait.
I mean, the market have been quite volatile because they worry about fiscal expansion or something that, Liz trusted, that's not actually funded, but huge fiscal changes.
Mm-hmm.
Is it something that monetary policy could fix if they needed to because of the widening spread between the French and German bonds?
Well, I think the ECB has its own tools. Clearly, there are conditions to these tools. One thing is the election promises, and the other thing is what will happen after the elections. And I think everybody has in mind the distrust experiment. It happened in Italy and hopefully in France also. So I think one has to see that the markets are going to make their own discipline in any case, and the ECB is there to do what it has to do. So
But we heard from the German finance minister that if the ECB were to intervene, he'd call it illegal. I mean, what do you make of those statements? Pretty strong.
Yeah, I think it's quite shocking, actually, because to have a finance minister who tells ECB what it can do and cannot do, I think it's a violation of the treaty, actually, because ECB is independent. So it's coming from a German finance minister, it's really surprising, because the treaty says that politicians should seek to avoid putting pressure on the ECB. So I think the ECB knows what it has to do, and one should not, I think, fall in the temptation to try to gain some votes. You know, we know that there are elections next year in Germany. I don't think the ECB should be part of this discussion, frankly.
But do you think this is what's happening? That it's basically, you know, ministers or non-ministers just try to get votes almost at no matter what cost?
Well, there is a risk, because otherwise I don't understand why at this stage a finance minister should tell the ECB what to do. It can comment afterwards, but threaten the ECB of going to courts. Actually, past experience with the German courts suggests that the ECB was always right. So I don't think it's a good idea if I can give any advice to the German finance minister, you know, think about your own problems. You have enough, I think, in Germany.
You're, of course, chairman of one of the biggest banks in France. Do you worry about this widening spread?
I think the markets have reacted slightly, and I think we are not concerned. I would say clearly the markets are doing their job. They're assessing risks. And I think those who will be in charge will take this into account. And of course, there are challenges ahead for all European countries. Growth is a key challenge. Competitiveness, you know, if you compare it to the US and to other parts of the world, Europe needs to grow, need to find the right balance in terms of fiscal adjustment. And experience of the past suggests that if you diverge too much, then you will be confronted with a problem of loss of credibility. So I think we are confident that this mechanism will work in terms of discipline.
But overall, what do you see in Europe at the moment? There's a lot of protest votes, and I don't know whether it goes to, you know, consumer sentiment, it goes to the economy, or it goes to something deeper that you can also pinpoint when you look at, you know, some of your Soc Gen clients.
Yes. Well, Europe is in a situation in which growth is certainly not the same as in the US, although we are close to full employment, but wages are not growing as fast, so people feel penalized by the inflation, which has, you know, is coming down, but still has penalized people. And they don't see what the solution is. So there is a temptation, and the elections in Europe have suggested that people would like to have more national solutions, while clearly, as economists, we know that if we compare ourselves to the US, what's missing is a large, big integrated market, like a European capital market, a European energy market, all these areas where Europe is small. And so in order to compete, we need to work more together. But politics are local in Europe, and then people tend to blame the national politicians for not taking care of their national economies. But in fact, what we should have is more European policies, more European coordination. So this is a dilemma, I would say, between how people feel and what is the optimal, ideal solution to be competitive in the global economy.
So if there are more inward-looking politicians that are elected, what does that mean for European growth? And actually, what does it also mean for the banks?
Well, in terms of markets, it means that it's going to be more difficult to have a true European capital market, a true European banking market, a true energy security. Then people will have to realize over time that maybe they were wrong in choosing more local policies, and that we need more European policies. But as in all democracies, you need to realize that maybe you have to change the choice that you made some years earlier. The important thing is that the institutional setup is there to make sure that we will still be able to vote 4 years from now, from 4 years from now, and you know, that's democracy. And it's not necessarily the case, and we've seen in Italy that a government which comes in with an agenda which is maybe more nationalist, over time doesn't realize that you need more Europe to treat immigration, for instance. In the end, I think the government and we all realize that within a single integrated area, having different national policies doesn't make sense. So over time, there is an educational process that will lead governments to, I think, to understand that only European policies are effective to deal with the issues that the people are concerned with.
Lorenzo Benismaghi, thank you so much for joining us. I was the chairman of Societe Generale and former ECB board member. Now, coming up, we talk politics, U.S. politics. The U.S. Supreme Court rules that Donald Trump has some immunity from criminal charges over his attempt to overturn the 2020 election result. What that decision means for the election, well, that's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So the European Bank of Reconstruction and Development has earmarked 300 million euros to help Ukraine overcome a critical shortage of electricity as a third winter in wartime approaches. Now let's discuss all of this, but also her outlook for the Eurozone inflation. EBRD's chief economist, Beata Jakrovic. Beata, thank you so much for joining us. I mean, first, it seems that politics is really overriding anything to do with the economics, but that touches what you need to do and step in for Ukraine. It also touches the kind of volatility that we're seeing in the markets. What do you worry about?
Well, first, I worry about Ukraine, and in particular about the energy sector in Ukraine. 70% of electricity generating capacity has been destroyed. So here we are stepping in, trying to finance, help rebuild, in particular to rebuild distributed generating capacity so that Ukraine can make it through the winter.
So is there a worry that actually because of the political divisions, because of the political factions in Europe, it's going to be harder for Ukraine to be supported longer term, as I guess, countries look inwards?
Well, we are committed to continue supporting Ukraine. We have received capital increase. So under war conditions, we expect to deploy between 1.5 and 2 billion every year. During reconstruction phase, about 4 billion.
Look at the French elections. There's been quite a lot of drama, certainly playing out in the markets. Could it really change the trajectory of the Eurozone?
Well, political uncertainty matters before the outcomes, the political outcomes, the new policies are revealed. Think about Brexit. After Britain invoked Article 50, nobody really knew what shape the post-Brexit relationship would take. And yet already at that point, we saw decline in online job postings in local labor markets, which were going to be exposed to barriers to services trade. We saw lower investment. We saw lower entry of firms into exporting to the EU. So uncertainty matters, and it's not just the actual policies, but the expected policies that have an effect.
So is that a way of saying that actually markets have almost front-run some of the uncertainty by placing bets? Then, will there be less volatile come Monday morning?
Well, volatility may remain, but markets are already incorporating some expectations about what the outcomes of the elections will mean, not only for policies of individual countries, but also for European policies. And let's not forget geopolitics. Sadly, the world is on a path to fragmentations. We see more and more trade barriers because policies on trade are not made by ministries of trade or ministries of economy, but rather by ministries of foreign affairs. So they are driven by politics, not economic considerations.
Do you see monetary policy changing because of these elections?
Well, I don't envy central bankers because the shocks they need to take into account can work both ways. On the one hand, Donald Trump is promising an all-around tariff in the US that could slow down European exports and European growth. On the other hand, the war raging in the Middle East could lead to higher oil prices that would fuel inflation. So policy making, particularly when it comes to monetary policy, is incredibly difficult these days.
Do you think it's been more difficult than in the past because of these? I mean, these are just the concerns that we know about.
Exactly. And then, but even the known concerns are still difficult to assess. Think about critical raw materials. Green transition means we need lots of minerals. Building an electric car requires 6 times in terms of mineral inputs as building a conventional car. And a lot of production of those critical raw materials is concentrated in China. Should there be escalation of geopolitical tensions, Europe may find itself scrambling for some of those raw materials.
So I've always heard that actually Europe doesn't have a robust enough energy policy to speak with one voice and lead us to the future. How does that get fixed?
Well, that's not just the energy policy, right? When you think about critical raw materials, Europe is striving to find alternative ways of supply. The problem is that an export restriction can be introduced at the stroke of a pen, while developing new sources of supply takes more than a decade.
So how do you fix that? Again, what's the right way of Europe dealing as a chief economist? When you look at the transition, what's needed also in terms of power, in terms of data, what should our policies be?
More cooperation. We definitely need more cooperation at the European level, because what gives Europe strength is the single market. And that's the best bet Europe can make in order to accelerate future growth. Deepening of the single market is the answer. We did a study looking at how much Eastern European countries benefited from their EU membership. And the answer is half of the catch-up they have achieved was due to the EU membership. At the same time, Western Europe sailed through the financial crisis in a less severe way because of that Eastern European market.
We're just talking to Lorenzo Bini-Smaghi, the chairman of Société Générale, and he was also saying, look, no matter what happens with politics, if it's politicians that are in charge that are more inward-looking, that puts in question the capital markets union, puts in question, a lot of unions that could happen with the EU. What does that mean to growth, and what does that mean to employment?
Well, the best way of stimulating growth and employment is to continue with the European project. And again, Brexit is a good example of how increased barriers, and in particular barriers to services, can have a detrimental impact on employment. So we need more cooperation rather than less, in particular on issues such as not only energy security, but also energy transition and grid transition.
I mean, Europe is also between, the U.S. and China, and we talked a little bit about that, what that means for critical minerals and politically being set in the middle. What does it mean for inflation? Are we importing deflation from China and importing inflation from the U.S.?
Well, there is a danger that if Europe follows the U.S. and escalates trade tensions with China, we are going to introduce trade barriers, which will increase inflation. But this fragmentation, this war, potential conflict with China could actually be detrimental to European growth. Let's not forget that Europe is much more dependent on exports and foreign trade than the US. So potential Chinese barriers would hurt us more than they hurt the US.
Beata, thank you so much for joining us. As always, that was the EBRD Chief Economist, Beata Jakovic, joining us from Sintra, Portugal. We also spoke to Austin Goolsbee, Chicago Fed President, and a little bit earlier on, we're speaking to Philip Lane. Plenty more to come from Sintra, and this is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Yes, I think the first two rate cuts are relatively easy as long as inflation, say, hovers around 2.5, because we would still clearly be restrictive. If we are still moving around 2.5 and contemplate other cuts, I think at some point it becomes more difficult. So we would really need to have strong indications that we are moving below 2.5 to 2%.
Well, that was the European Central Bank Governing Council member Pierre Wunsch there speaking to Bloomberg. Now, a fraud suit against stocks influencer Keith Gill has been dropped within days of its filing. A GameStop shareholder had accused Gill, also known as Roaring Kitty, of engaging in a pump and dump scheme. Now, it's unclear why the suit was dropped. Gill was one of the faces of the 2021 meme stock craze and reemerged in May with new posts about holdings in GameStop. General Electric has agreed to keep Chief Executive Larry Culp in the top job at the aerospace manufacturer until at least 2027. The extension comes after Culp orchestrated a multi-year turnaround of the former conglomerate, culminating with the spin-off in April of its energy-related businesses. Well, that left GE Aerospace, the world's largest maker of jet engines, as a remaining company. Northern Data is said to be considering an U.S. IPO of its combined AI, cloud computing, and data center businesses. Now, the potential listing could fetch a valuation of as much as $16 billion and is targeting a debut on the NASDAQ as early as next year. Well, sources say Northern Data may also sell a minority stake in the unit to investors ahead of the listing. Now, in other news, Paramount shares jumped and in extended trading after a New York Times report that billionaire Barry Diller is exploring a takeover bid. Well, Diller's digital media conglomerate IAC has reportedly signed non-disclosure agreements with Paramount's controlling shareholder, National Amusements. Well, Diller's interest comes after a takeover bid by Skydance fell through. And Hurricane Beryl has reached Category 5 strength as it heads across the Caribbean for Jamaica. That's the earliest point in the year that an Atlantic storm has reached that strength. Now, the U.S. National Hurricane Center says maximum sustained winds have increased to around 260 kilometers per hour, with gusts even higher. Well, coming up, we have a lot of interviews here from Sintra, Portugal. Our interview with the Bank of Portugal Governor, Mário Centeno. This is, of course, at the ECB Forum. We also heard from Christine Lagarde. She gave a speech yesterday to really kick us off. And we also spoke to Philip Lane a little bit earlier. The meet and takeaways is that it's a little bit too soon on what they cut next, but it seems that both actually took July off the table. We also speak to Torsten Slot, Chief Economist at Apollo. All of that and much more coming up from Sintra at the ECB Forum. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Sintra, Portugal. Now, investors are watching for your area CPI inflation due out in the next half an hour. Let's take a closer look now at the outlook for the ECB with Mário Centeno, the Bank of Portugal governor. Governor Centeno, thank you so much for joining us. Congratulations, first of all, on the football. We're here in Sintra. I have to say the room was quite hectic and looking for the penalties, but you've made it.
Well, thank you for having me. Both teams were brave, but at the end, Portugal prevailed.
Portugal got it. Could you be as confident on the Eurozone economy? There's a number of headwinds, including politics in France. Does it complicate how you set monetary policy?
Well, let's take a little bit of a longer perspective. On the one hand, our baseline is solid. Inflation came our way actually faster than expected after big crisis as COVID and then this inflation process. I think we must be moderately proud of ourselves in the sense that inflation is about to close to 2% in our forecast horizon, very well anchored. The economy, we have a positive surprise in the first quarter of 2024. We must build on that.
And the ECB cuts, and it was fine, it was well telegraphed, well received by the markets. How many more cuts do you think there will be this year?
Well, that's a different story. I would rather prefer to see things as we move. Again, if the baseline is solid, there are still headwinds, as you mentioned. And we must build on our successes. The labor market is very important for the European economy these days. It's the pillar of stability in our economies. So we need, as policymakers, to also contribute to this smooth transition. We call it soft landing. But soft landing is not a normal status in such a high pressure financial conditions that, of course, the interest rate hike generated. So I expect a few more rate cuts this year. We think that we need to follow the meeting by meeting strategy, and hopefully the data continues to come our way.
So, Governor, are you worried that actually a soft landing is not a given? That I guess it's the base case, but there's a number of things that if you calibrate wrong, could go the other way.
That's always something that we need to be concerned with. And given how much of this hinges in the labor market performance, on this very high level of employment, low unemployment, great dynamics in our labor market, we all hope, and this is the baseline, that this will continue. Our forecast is a lot sustained by consumption increase. This requires real disposable income also to increase. Real wages have to catch up from the reduction that we observed during the last couple of years. For all of this to be materialized, we need also policy and monetary policy to contribute to.
I mean, the market was hoping for some kind of guideline, I guess, on how interest rates will go down further. Mm-hmm. There seems to be an assumption from Christine Lagarde, but also from Philip Lane, that probably you need a little bit more to cut again. So is July off the table for an interest rate cut?
Well, from our methodology perspective, not. We need to see how inflation numbers will come up in less than half an hour. The country numbers all are in line and slightly below, actually, the forecast. Let's see what we have. But take always a longer perspective. That's my point. We need to know where we come from. Very difficult situation, very successful in terms of policy in Europe. It was not only monetary policy. We need to share this success with workers, firms, governments, because fiscal policy in Europe also played much more moderately pressures on prices than in the US. So this was a collective match, as any soccer match plays down, and we need to continue this into the future, being prudent and confident. Those are the two words.
Governor, what are you most prudent about? Again, and I know you don't want to talk too much about what's happening here and now, but you had quite a sizable, widening of the spread between Germany and France. Are things like that worrying for you?
Again, for that, we need to call into action the old framework that we have in Europe. We have a very strong and sustained fiscal orientation in Europe. We have a new version of the Stability and Growth Pact being applied since this year. That's a big issue for Europe, of course. We all have to have an eye on that, but we have to play collectively again. So I think every part of the game will do its own job, and I'm very positive that we will be able to make it.
How does U.S. Fed policy, or the U.S. in general, actually impact your thinking of what kind of growth we'll see in Europe and what kind of inflation we're importing?
We live in a global world, so we were very lucky to be highly synchronized in terms of monetary policy in the last couple of years. We want to continue that level of synchronization, but we need to look at our numbers. And the numbers in Europe differ from those in the US in different perspectives. It's not only inflation that looks set to fall faster in Europe than in the US. The US economy is growing more than the European one, but you must remember the fiscal stimulus that there was in the US, and also the push through consumption that the US had and Europe didn't. So we need to look at in the global context. If I am to say, as an European, I think the path of European growth and policy-wise was more stable and sustainable than in the US. I mean, we did not have the big fiscal stimulus that the US had. We managed to cope with COVID in a more solidarity way. We issue a common debt in Europe, which was something that was out of the cards for a long period.
With how Europe handled it?
Yes, and that I am very positive. And we need to communicate this also, because our citizens, of course, suffer the challenges and the uncertainty that the global difficulties that we see, wars, and we have a war in Europe. We sometimes forget about it. And we have to fight it, and we have to win it, of course.
Governor, talk to me a little bit. The commercial real estate, but also in general, private credit is something that's worrying, central banks. Mm-hmm. Are you worried about the shadow banking, the things that's not regulated?
I mean, we, again, in that perspective, in Europe, the monetary policy transmission was very forceful. Credit has been almost flat in nominal terms, which means that in real terms it's really falling. We have our bank supervision playing out, in which we evaluate very positively. There are always challenges around those subjects that you mentioned, and we need to keep an eye on them as always. But so far, again, if you look the banking sector, the troubles that you saw in the U.S., this issue of Credit Suisse, we didn't have anything like that in the euro area.
So you don't think there's something ugly coming that could be systemically important?
Not in the baseline, and the baseline again is solid. We need to do scenarios for risks and headwinds that sometimes may be ahead of us, and we need to be prepared to deal with them. But I will remain very positive and very open, meeting by meeting, to do whatever is necessary. Also to contribute to this positive tone that, again, our citizens need to listen from us policymakers, because we are here to be cautious, to be prudent, but also to send positive messages.
Mario Centeno, thank you so much for joining us. That was the Bank of Portugal governor. Now, we'll have plenty more from Sintra, Portugal, throughout the day. Coming up, economics also in focus ahead of the U.S. jobs report on Friday. We'll be speaking to Torsten Slok, partner and chief economist at Apollo Management, here at the ECB's forum in Sintra. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Second half of last year, in the U.S., we had 7 straight months of excellent inflation. We hit a bump in the road in January of this year, but now we've gotten a string of improved inflation readings. If we get more like what we have just seen, to me, that feels like the path to 2%.
Well, that was Austin Goolsbee, the Fed Chicago president, on promising U.S. inflation readings, which could then lead the Fed to make rate cuts. Now, I sat down with him a little earlier here at the ECB forum in Sintra. Now, joining us now to put all of this together, we talked, of course, about Europe. We talked about the U.S. Here with me in Sintra is Torsten Slok, partner and chief economist at Apollo Management. Torsten, I've been trying to speak to you so long. You see, I have to show up at the ECB forum to make sure that I get your perspective on things. We just heard from Austin Goolsbee. We also heard from Philip Blaine. If you put everything together, there does seem to be a little bit of reticence to actually cut interest rates. They're so data dependent or data point dependent.
Yeah, I think that one conclusion, at least from the conference here and from also what you've been talking to people about, is that I do think that we in markets need to think of this as rates are going to stay higher for longer. In the U.S., of course, we've been through quite a roller coaster ride this year, expecting a lot of cuts, then fewer cuts, then more cuts, and now fewer cuts. In Europe, also again, earlier this year, a lot of cuts were expected. Now the market is talking about 1, 2, maybe 3 cuts in the most extreme case, but much fewer cuts than what we had expected earlier this year. So I think higher for longer continues to be the dominant theme.
But Torsten, is that a problem for the Fed? I mean, we've heard a number of outside economists, including Mohamed El-Erian, saying like, look, if you wait, then you could potentially see more problems in terms of risks.
Well, that raises exactly a very important debate about why is it that we need to keep rates higher for longer? What are the tailwinds that are keeping growth so strong, not only in the US, but also in Europe? In the US, you have two very special idiosyncratic tailwinds, namely number one, we still have strong fiscal support. The CHIPS Act, the Inflation Reduction, the Infrastructure Act are still fiscal policies that will support GDP probably over the next several years. The second thing also the US has as a tailwind is very easy financial conditions. The stock market continues to go up because of AI. That gives strong investment in AI. That gives strong wealth effect from the stocks in AI going up. All this is also a very separate, very significant tailwind in the US outlook. And that tailwind is also spilling a bit over to the European outlook. The data has been surprising a little bit more up to the upside, and still easy financial conditions in Europe also providing enough support. Probably, again, the main reasons why the economies, both in US and Europe, continue to actually do quite well.
Torsten, I mean, some of the other things that we explored, for example, with Austin Goolsbee, is this idea that, you know, when you look at consumer sentiment, it's been politicized. And so I guess the surveys may not be as reliant as they used to be in the past. Does that just put more emphasis on employment and therefore the employment number on Friday?
Yeah, because the Fed has a dual mandate of both inflation at 2% and employment. The ECB has a clear only one mandate, namely inflation. And what's exactly right, Francine, is that in the US, you've seen especially inflation expectations show a very distinct pattern where you're seeing inflation expectations in the median are very stable at 3.1% over the next 5 to 10 years. The median voter thinks that inflation will be stable in the long run. But the mean of inflation expectations is much higher at around 7. So that means that you have half of the population in the US having inflation expectations that are much, much higher than the other half. And that is indeed creating a lot of debates around what is consumer sentiment, what are inflation expectations, and therefore what is the broader narrative that is told in terms of one part of the population relative to the other part of the population.
Torsten, what do you see as the biggest risk out there? We talked about commercial real estate with some of the participants. We talked about private credit. We were talking about inflation. But is there something that we have not thought about?
Well, I think some of the things that you also just spoke about with Centena, namely that we have still issues with commercial real estate, is still a risk, in particular in the US. But it is still the case with work from home that office occupancy rates continue to move higher. At the same time, interest rates higher for longer. It's just a bad cocktail if you both have occupancy rates that are relatively low compared to historical levels, and at the same time, you also have interest rates that are higher. So one area is certainly commercial real estate is a problem, not only in the US, but also in Europe. Another area where you also have some problems, of course, is still geopolitical risk, and for that matter, political risks, both sitting here in Europe, but also in the US. A lot of uncertain things that are now beginning. Yesterday, it did begin to maybe matter a little bit more in markets in the US, the election, but a lot of these things may become, over the next several months, a very important factor when markets begin to talk about, well, should the yield curve be steeper? Are there risks in terms of the fiscal outlook, not only, of course, when it comes to France and Europe, but also when it comes to the US?
I mean, should we, or could we, after the US election, be talking about a possible interest rate hike depending on some of the fiscal policy put in place?
Well, at least for now, markets are pricing just, of course, a cut here potentially in September and then another cut in December in the US. So we both have 2 cuts priced at the ECB and 2 cuts priced at the Fed. But it is very clear that both with the French election and also with the US election, that it remains to be seen what policies come out on the other side. And if, of course, politicians, not only in the US, but also in Europe, decide to do expansive fiscal policy, more tailwinds to the economy, on top of the tailwind of easy financial conditions, and on top of the existing tailwinds from easy fiscal policy, that could, of course, open up conversations about, well, maybe rates need to stay higher for a lot longer than what markets currently are pricing. So that's why we have been saying for quite some time that we don't think the Fed will be cutting rates this year, because we do still think that the tailwinds to growth are quite strong.
Torsten, it's very clear the policymakers here in Sintra were shying away from talking French politics and saying, you know, it's an election cycle, it's normal, even the widening of the spreads is something that we're used to. How do you view it? Could it actually change a monetary policy in the Eurozone, but also growth trajectories?
Well, I think that, it is very early. We need the second round. I still think that the baseline for the ECB is likely not changed on the back of anything that has happened up to this point. But it's pretty clear that the people you have had sitting in this chair earlier today think probably a lot about what the consequences might be. And the difficult challenge for everyone, including us in markets, is how do you quantify these different political risks? We all have a very nice little spreadsheet where we forecast, here's what inflation will be, here's what unemployment will be. But how do I put into my model these various aspects of political risks, both in Europe and in the US, it just becomes really difficult to get a quantified measure of how much the impact will be, even on, of course, on the fiscal front and ultimately on GDP and on inflation.
And so what kind of metrics do you look at? Again, is it fiscal spending for France and is it fiscal spending for the US, or is it something else?
Yeah, well, that's why I think there's something else really is the data dependency, and therefore figuring out, is the incoming data behaving as the central banks, as the ECB and as the Fed have been predicting, or are there signs that it's actually a little bit better, which has been both in Europe and in the US in the last several months. So if that's the case, well, maybe we're not quite seeing that slowdown, and maybe therefore the data dependency is coming back. That's been coming back, of course, for the Fed especially, but also for the ECB, focusing on, is the incoming data behaving as their forecast would have predicted.
And China predictions are also quite tricky.
Yeah, because China, of course, also has a lot of challenges with both demographic headwinds, with the housing market that's deflating. You also have exports are falling. And those things combined also, of course, probably mean that housing growth especially will be putting downward pressure on growth in China for, in our view, probably the next several years. And if that's the case, that's, of course, going to hurt German exporters that export to China. And that's also going to create a lot of other ripple effects across, especially emerging markets. And therefore, global growth from the impetus of lower growth in China is probably going to get a negative impact. But that's why that's being offset by easy fiscal policy and also easy financial conditions.
Torsten, thank you so much for joining us today. That was Torsten Slok, partner and chief economist at Apollo Management. Now, we'll have plenty more, of course, from here throughout the day. Coming up, the ECB's chief economist says June inflation will not be enough to move the dial on interest rate cuts. Our exclusive conversation with Philip Lane. That's next, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Now, the ECB's chief economist says June's inflation data will not provide answers to the bank's lingering questions on underlying price pressures. While speaking exclusively here in Sintra, Philip Lane signaled that a July cut is unlikely.
we're in mid-twos, and what we said in the June projection, essentially we're going to be in mid-twos into early next year. But then I think there's a lot of foundations in the movement from this year to next year to see inflation come down to our target in the second half of next year. And I think what we've seen the last day or two with the early indications of the June inflation data is in line with that assessment.
But is it too early to cry victory? And so what does that look like in terms of future interest rate cuts?
So I know it's a very natural question to ask, and what I've said before is under the baseline projection in June, of course, we're not going to remain where we are. Now, we have essentially 8 meetings between now and this time next year. This time next year, again, under the projection, we're going to be looking at the second half of 25 at targets. So clearly, being at target and having an interest rate at 3.75 is not where we're going to be. But the exact timeline will depend, I think, as President Lagarde said in the speech last night, essentially looking for extra confidence about the, if you like, the remaining disinflation we need to do. And the key issue there is really services inflation. And what we've seen in the last day is essentially services inflation remaining the outlier. It remains relatively elevated. And what we need to see is that relatively high services inflation just a backward element? It's a legacy of the rapid disinflation that it's still working its way through services inflation, or is there any persistent element? And I think right now we need to take a little bit of time to work on that.
Well, that was the ECB Chief Economist Philip Lane speaking to me here earlier in Sintra. Now, here's what to watch for today. First of all, Euro area CPI in just a few minutes. We also have the U.S. jobs data a little bit later today, and of course the ECB forum where I'm at here in Sintra. We'll hear from Christine Lagarde, Campos Neto, and of course Jay Powell a little bit later on. Up next, Bloomberg Brief with Danny Berger and Manus Krani in New York, and this is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AfDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Partially immune, the Supreme Court rules that Trump has some immunity over his criminal charges. Democrats rush to confirm Biden as their nominee. Fed Chair Powell and ECB President Lagarde speak in Sintra after policymakers signal they need to see more evidence before cutting rates. And ready to make a bid, billionaire Barry Diller is reportedly in talks for control of Paramount following the failed attempt by Skydance. Good morning, Manus.
Danny, good morning. We deal with the triptych of politics and what it means for global markets. There's a dislocation when it comes to the yield curve spiking. We'll talk more about that in a moment. 445 is where you are on 10s at the moment. The yield curve moves by over 12 basis points at one juncture. Yes, these stocks this morning. Again, I talked about a triptych of politics. France, the UK and the USA. It's going to be about the flow of capital. That's representative in the bond market this morning and over the past couple of days. JP Morgan has a note out saying this is as good as it gets on equities going into the second half of the year. You're going to have a myriad of headwinds on growth. Tesla this morning, keep an eye on that. You're looking at Tesla. Let me just see. I think we're down 1% at the moment on Tesla. Nvidia also dropping a little bit. And when it comes to the dollar, this is what we've got for you. Dollar yen again back at a 38-year low. The dollar is stronger on the prospect of a Trump victory and a Republican sweep, but this dollar is trending higher, the yen at a 38-year low. And again, the market is really reflecting on what does this partial immunity for Trump mean as we run up further to the election. A little bit of breaking news from the EU on the inflation side. Danny, what have we got?
So we have inflation, CPI, Manus, coming in line year over year, 2.5%. The estimate was for 2.5%. So good news for the ECB on that progress. Maybe the slight bad news here, Manus, is what core looks like. Core coming in 2.9%. The estimate had been for slightly lower than that, 2.8%. So 2.9% also matches the prior month. And so perhaps shows a stalling out of services inflation. We need to look down at the components, but we heard from the chief economist, Philip Lane, speaking with Francine over in Sintra, basically saying that services is the issue. It is too early to tell whether it's coming down. The fact that core inflation looks sticky might point to that.
And as he's actually made the point very clearly just a moment ago, that the disinflation, which is there, they're going to be in a different position in a year's time, but it's whether the services inflation has still got that lag in it, unlike the manufacturing side, whether it's legacy or persistent.
Yeah, correct. And just to go over the month-over-month numbers, 0%, so flat there for CPI. Again, 2.5% is the headline, 2.9 the core. And as we're saying, they've all been in Central Manus. And ECB President Lagarde spoke yesterday, saying that the central bank doesn't yet have sufficient evidence that inflation threats have passed.
We are still facing several uncertainties regarding future inflation, especially in terms of how the nexus of profits, wages and productivity will evolve, and whether the economy will be hit by new supply-side shocks. And it will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed.
Let's get to Sintra now. Over there is Bloomberg's Francine Lacqua. Francine, you've been doing great work there. I was just talking to Manus about that interview with Philip Lane and the need for more evidence. So we have a little bit more evidence. We have CPI numbers for the euro area. Do you think it'll affect at all some of the policymakers you've been speaking to, their thinking?
Well, good morning to both of you. And it's very clear that, yes, of course, at the margins, it will impact what they'll say, going forward. But there's been a concerted effort from Christine Lagarde yesterday. I have to say it was a fine speech also because there were many football analogies. I think she finished it off by saying, look, if you go back to Sir Bobby Robinson, he said the first 90 minutes of the football game are important. And that was intimating that also, look, whatever happens, the ECB will not keep its eyes off inflation. So she was also intimating that it's a little bit too soon, even if there were encouraging figures in some parts in inflation today of when they cut next. We had the similar message from Philip Lane. I mean, he just went to say, look, if you look at services inflation, we just need a little bit more time to actually understand what's going on. So possibly July could be taken off the table. Again, I feel like when you speak to Torsten Slok, who tried to put everything together, we do have the big monetary policy panel a little bit later on, that maybe we're in now an era of higher for longer, also because of the politics, also because of all of the uncertainty in geopolitics, which I have to say everyone's talked about in the corridors, but no one will really go on the record with it.
Yeah, and therein lies the problem. Everybody's sort of whispering about what the possible changes are politically, not just here in the United States, but also in the second round in France. And of course, you've got the UK as well. You talked about the panel a little bit later on. And here's the conundrum for Powell. What do we expect him to say? Lagarde has, again, along with Lane, asked for more time to consider the data. Do you think that Powell will invoke the same spirit of uncertainty?
I think so, Manus. I think both of them will try and push back against giving the market some kind of very clear time frame. Now, remember, it started kind of at the end of December, where the ECB was very clear on when they would cut. June was always the goal point. And through various speeches, through various forums, they made that very clear. We've seen also from Jay Powell really going through great lengths of trying not to give this clear timeline to the markets. And we've now seen the same from the ECB. You could argue that's because uncertainty has actually increased because of the politics, but you could also argue that they're just waiting for the data points. Now, I spoke to Austin Goolsbee, the Chicago Fed president, and he was very careful. I mean, I asked him 3 times whether he saw 2 cuts from the Fed this year and whether once it's cut, then it's cut after cut like in previous cycles. And he was very, very careful in basically saying that he didn't want to game the market, that the market has to do their own work, but for the moment, they're very data dependent.
Okay, well, certainly a building narrative is it's going to be a much shallower cutting regime that we go into if and when that starts at all this year. Francine, thank you very much. Francine Lacroix on location in Sintra, and a feast of interviews past, and there will be more to come. Our next guest writes this: although the prospects for interest rate cuts were an important driver of the market rally in the first half of 2024, looking ahead, the rationale for the delay in the Fed rate cuts, it's critical to the equity outlook. Our guest this morning is Seema Shah, Chief Global Strategist over at Principal Asset Management. Seema, good to see you this morning. Again, you lay the groundwork very clearly, which is the rationale for holding off on cuts is because of a strong economy. That's good for risk. That's good for equities. That's the soft landing. But what do you make of the thesis that, look, you're going to run into massive political volatility headwinds and that this is as good as it gets for equities? Do you fight back against that? Good morning.
Good morning. Yeah, I do. I mean, look, this isn't new. We've seen election after election that there's always going to be volatility. There's a lot of uncertainty. Polls have not been the best predictors as well of some of the results. So I think it's really actually important that investors try and look through some of that election noise and really stay focused on the fundamentals. Now, there has been obviously some interesting developments with regards to thinking about what the inflation outlook would be under a new government in the US. And certainly that is the kind of thing that could sway the way that investors start to think about interest rate cuts going forward, and of course the equity market. But I think it's a little bit too early. There's a lot of promises made in the run-up to an election. Whether or not it comes through is always going to be a slightly different question.
Seema, I'm with you. I was talking to Manus about it this morning. Not only is it really early, but we're also so bad at figuring out the path of inflation. I think we've learned that lesson over and over again for the past 4 years. But for those that are calling for curve steepeners, I mean, there are so many of them now. Goldman, Morgan Stanley, BNP, Barclays, all saying go to curve steepeners. Is there a tactical play to be had that at least you want to hop on this bandwagon for now and see how it plays out?
So I think that there is something to be said about the idea that with this, you know, and not just, of course, in the US, but actually globally, that there is so much focus on fiscal discipline. Budget deficits are significantly larger post-COVID, and governments are having to think about what they can do. And of course, they want to provide their electorate with some kind of boost to growth, but they're very much limited. So actually, when we think about this, yes, there's probably some upward pressure on longer-term yields. But when you're combining that with the potential for rate cuts, from our perspective, this just means that treasuries in particular are quite range-bound. So where we are today, I think, is bang in the middle of that range. You could see a little bit upward movement. But then as soon as you get a clear indication that the Fed is close to cutting rates, then I would expect there to be renewed downward pressure.
How close are we to that cutting of rates? We've just had the inflation data in Europe, and again, they're all requesting time from the market. And the question for the market is, you know, we go into this back half of the year with politics being the dominant theme and disinflation. How convinced are you that the disinflation theme will continue in the United States and allow them to cut twice? Francine had a struggle to get Goolsbee to sort of go with her on the journey to 2 cuts.
Yeah, so we have got some confidence. I wouldn't say that it's a huge amount of conviction at this point in time, simply because when we're thinking about the inflation numbers, you were looking at the subsectors of inflation, which inevitably does create a lot of uncertainty with regards to how that's going to pan out. But if you take a step back and look at the way that the economy is evolving, we do still expect there to be a soft landing, but that does also mean a slight softening in growth, which should put downward pressure on inflation. So from our perspective, it's still, a September hike is still on the table. A lot of the narrative that you're seeing coming out from central bankers today, this week from Sintra, we think is about taking off that July cut from the table. Because as I said, there's a lot of uncertainty. They need to see how the data plays out. But certainly for us, as we look forward over the coming months, we think there will be sufficient evidence to give them that comfort to begin cuts come September.
Seema, we started out by incorporating this into your equity outlook. One of the things I've been shocked by is every morning so far this week, I've woken up and I've checked NVIDIA, which appears to be the thing to do these days. And it has been down. Yesterday, it barely eked out a gain, just about 0.5%. Yet the Mag 7 hit another all-time high. The equity market is being supported, even though NVIDIA looks to kind of be lagging around. Do you think something is happening? Is that meaningful to you? Could this be a momentum shift, or is it a breather in a continuing story of there is no alternative to NVIDIA?
I mean, I think at this point in time, it's been interesting because we came into 2024 and the general consensus was that this would be a very different year to 2023, which was, of course, very much driven by the Mag 7. And then fast forward 6 months and here we are again. It looks a lot like 2023, where the Mag 7 are really the only game in town. Now, if we're looking forward again and we think that, yes, growth is slowing, but it's still solid, then you should see, as we've already seen actually in Q1 earnings, that good performance is spreading out to a number of different sectors. And that should provide some kind of support for the broader market. Of course, it probably wouldn't be enough if the Mag 7 is really going to hit a wall. So there is a concentration risk. We do think that you should actually start thinking outside the US, where the opportunity is there to provide that little bit of diversification against the risk that valuations are getting very frothy and you are seeing some nervousness enter the market about those Mag 7.
Well, there's no doubt about it. Here in the US, we have this, as David Kelly said yesterday, we have this euphoria at the top, but that that excitement, that euphoria is not stretching out to the broader market. When you stand back and look at the next 6 months, what is the most important pillar in the portfolio that I need to have? Is it a hedge against a lack of disinflation? Is it a hedge against concentration risk in the United States of America?
So I think it's important that you don't just, obviously I don't think there's one segment. I think at this point in time when you have got valuations in certain parts of the market which are very, very strong, you have to have an array of ideas within the portfolio. So I mean, I think, of course, you should have exposure to those big tech names, and I think it's a time to reduce it, but also not be looking to increase it. As I said before, international exposure is going to be really key. So looking outside of those tech sectors, outside the US, into various parts of the market, if you're thinking about India to Korea to parts of Latin America. And then with fixed income, there is a chance that you get a bit of a slowdown. You are seeing more concerns creep into investors' discussions that they're looking at a potential hard landing. That is creeping in. So having exposure to fixed income that can give you that protection. And then, Manus, to your point, inflation concerns still there. So we have got exposure to real assets. So we're thinking more commodities and hedge funds at this point in time.
Feels like a repeat of 2023 then in more ways than one if we're starting that hard landing conversation again. Seema, it is always such a pleasure to have you on. Seema Shah of Principal Asset Management. Okay, Manus, let's get to some of the other top stories that are trending on the terminal this morning. Bridgewater is launching a $2 billion fund that uses machine learning in its decision-making. Sources say the fund began trading Monday with capital from more than half a dozen clients. The hedge fund giant is leading on its own tech, but the new fund will also broaden to include other models from OpenAI, Anthropic, and Perplexity.
Northern Data is said to be considering a U.S. IPO of its combined AI, cloud computing, and data center businesses. The potential listing could fetch valuation as much as $16 billion and is targeting a debut on the NASDAQ as early as next year. Coming up on the show, the U.S. Supreme Court says Trump has some immunity from prosecution, a decision with consequences for the election. Context matters on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
The American people must decide Trump's embrace of violence to preserve his power is acceptable. Perhaps most importantly, the American people must decide they want to entrust the president once again, the presidency, to Donald Trump, now knowing he'll be even more emboldened to do whatever he pleases whenever he wants to do it.
President Joe Biden there commenting on the news of the Supreme Court granting Donald Trump partial immunity from prosecution. The former U.S. president posted his own reaction to the news on Truth Social, calling for the decision a big win for our Constitution and democracy, saying he was proud to be an American. So let's start this conversation with Kriti Gupta. She joins us now. Kriti, look, this ruling passes the baton back from the Supreme Court down to the lower court, but what's it going to mean for the overall ruling? What's it going to mean for Trump's trial on charges relating to overturning the 2020 election result?
I think for our international audience, what we need to know is this just pushes out the timeline even further. So any outcome or even the start of a trial is likely to begin after Election Day in the States. What you need to know here is that now that it has been kicked down to the lower courts, the federal court judge in particular now has to kind of do the parsing out between what is an official act and what is a private act. Remember, we are in uncharted territory when it comes to legal precedent. No precedent has ever had these dealings. What that means, though, is going to take a couple of weeks, potentially months, to kind of create that difference between what is qualified as presidential duties versus what is a private citizen's duties. That being said, even then, the judge has said that she was planning in previous iterations of this conversation to have 2 to 3 months of prep time and then potentially 3 months of trial time.
Kriti, I mean, as Manus and I have been talking to people, there's been a shift where people are more willing to start to price in a Trump presidency. And after the debate and what has been called the disastrous result from Joe Biden, this was just out about 18 minutes ago from the politics team, that Joe Biden's campaign has raised $127 million in June. That is their best fundraising month of the cycle, and it includes $38 million raised in the 4 days starting Thursday. So clearly a lot of money raised after the debate. The Democrats will obviously see the Trump ruling as a blow. But what does this mean with the money raised and some of the news and noise around getting him confirmed sooner as the party's candidate for the team, for the Democrats, and sticking with Joe Biden?
So let's start with the campaign performance specifically, because this is something that the Biden administration from the gates had actually said, and the campaign, I should say, had said, even just in the hours after the debate itself. Remember, Joe Biden went from Atlanta to a rally in North Carolina straight to New York and New Jersey, again to court, especially some of the big Wall Street donors that he needed to court at fundraisers hosted by New Jersey Governor Phil Murphy. So this is kind of in line with what we've been hearing out of the campaign. As far as the timeline moving forward, there was always going to be a virtual roll call for the Democratic nominee, and this wasn't really an issue because President Biden was the presumptive nominee. That is in line to meet that Ohio ballot deadline of August 7th. That being said, the question of the timing was still uncertain. Now it looks like there's some reports that's going to be shooting for in and around July 21st, in which case it's basically going to be confirming what we already know, which is that a lot of the electoral votes have already been promised to Joe Biden simply because he won those swing states.
Okay, well, it's certainly trying to batten down the hatches and reduce the overall risk. I mean, they're in full defense mode at the moment. I think Terry Haynes' line this morning is the case about the limits of POTUS immunity is a bipartisan parade of vanities and horribles that today debase U.S. politics. Kriti, thank you very much. Great work there, putting the context around it. Coming up on the show with Danny and I, the student has to pass the teacher. We discuss Bill Gates being the 6th richest person in the world. Who could chase him? There you go, Mr. Ballmer. There you go. We'll talk about him in a moment.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that, moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
What's on your front pages this morning? This is what is making headlines around the world. First up, of course, it's the hurricane. CNN talks about Hurricane Beryl charging towards Jamaica at a record-breaking Category 5 storm, Danny, after leaving the Caribbean islands in ruins. Strongest storm ever at this time of the year in the Atlantic, 165 miles per hour winds. Oil is bid on the back of this, up 0.7%. Obviously, a big concern there in the region.
This could also be moving oil. This one on the Financial Times on the front page is writing that Iran could use all means to back Hezbollah if Israel launches a full-blown war. That's according to an aide of the Iranian supreme leader. We know Israel has been more forcefully attacking Hezbollah. Yeah. There's this concern that it escalates thing, but apparently they've told Iran has told the FT that they're not interested in a regional war.
And finally, we have a story about Steve Ballmer. He is now richer than Bill Gates. This comes down to, of course, he was the first CEO over at Microsoft. This is called stay and hold, buy and hold, or get given and hold, which is Microsoft CEO Ballmer. He's worth $157 billion versus Gates. He diversified, $156.7 billion. Diversification doesn't always work.
I was going to say, this is like the perfect example of how messed up this market is. Maybe not messed up perfect for Steve Ballmer, I should say.
Yes.
But diversification isn't working right now. You just got to own one of the Mag 7s, which, hey, Microsoft is in, and if you just ride that bad boy to the top, you too can be richer than Bill Gates.
There you go. I mean, I tell you what, I think we're going to be working a few more 5 a.m.s and a few more briefs before we hit these heady levels. But of course, we're going to talk a little bit about the NBA in a moment. Of course, he bought the Clippers. That was a long time ago.
He did buy the Clippers.
Mr.
Sports
Ballmer,
news. We're going to have some sports news for you later in the show. Stick around for that.
But
first,
me about American sports.
I am. It's a long road, but we're getting there.
What's it like moving from the East Coast
where everything is finance and money, to the West Coast, where everything is technology. Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Partially immune, the Supreme Court rules that Trump has some immunity over his criminal charges. Democrats rush to confirm Biden as their nominee. The Fed Chair Powell and ECB President Lagarde speak in Sintra after policymakers signal they need more evidence before cutting. And ready to make a bid, billionaire Barry Diller is reportedly in talks for control of, you got it, Paramount, following the failed attempt by Skydance.
Manus, I think the best person to really encapsulate the environment we're in is Lori Calvasina over at RBC. Raised her price target, she says nervously, but called it a fog for 2024 and 2025. We're seeing some of that fog play out, whether it's trying to figure out how policy applies. S&P 500 futures, they are weaker this morning, down by 0.4%. NVIDIA leads the market lower. It was barely up yesterday, even though the Mag 7 hit an all-time high. It is a busy calendar for you for these bond markets. We have the ECB and Powell speaking at Sintra in Portugal, UK elections on Thursday, jobs data Friday, and plenty in between. Yields basically unchanged. 4.45% is where we stand. The euro is weaker this morning, down by about 0.2%. But Manus, again, I think it's really interesting talking to Seema Shah from Principal about what inflationary impact Trump might have, because there's a willingness now to actually speak about it. After the debate performance on Thursday, you're getting these calls come in, call after call, about inflation and about Trump.
Well, there's certainly a frenetic response. You know, you can definitely see that. And we're going to talk to our next guest about this. But there's a frenzy of action, not just even on the steepeners, but on the outrights as well, and on the break-evens. And we're talking to different people on the IB, and they talk about perhaps keep an eye more so on the 5-year and the 10-year break-evens as more of a prescient issue for the bond market. But there's a real frenzy to the notes, isn't there?
Yeah, but I get back to this thing of we're so bad at trying to figure out the trajectory of inflation. If anything, the past 4 years have taught us that. And also, how do you really figure out?
Not a lot of humility, though, in the average bond trader, though, is there, for getting inflation wrong?
Oh, yeah. No, if anyone has
Have you met a
humility,
humble bond trader?
Have you met a humble equity trader? Comparatively, they're a little bit humble. No, but Manus, to your point, I mean, you can see it in the yield curve. I think we have this chart. There has been a shift since the debate. The yield curve, if you just look at that top panel there, it's gone up by about 13 basis points in 3 days. The steepeners have put on, it has been bear steepening on this assumption that Trump policies would invoke some inflation. Joining us now is John Riding, Chief Economic Advisor at Breen Capital. I mean, John, the calls are one after another. BNP, Goldman, Morgan Stanley, Barclays, look at curve steepeners. There's going to be inflation because Trump wants maybe a dovish central banker and is going to do tariffs, tax cuts, inflationary policies. Are you among those who see that?
Well, inflation's
as Milton Friedman famously said, is a monetary phenomenon. So the Federal Reserve is the bulwark that the economy has against inflation if it does its job. Now, it can make mistakes. It made a big mistake in 2021 by continuing to ease by buying bonds and saying that the inflation pickup was transitory. And it has learned from that. And now, arguably, on the other side, is a little too resistant to cutting interest rates. But the makeup of the Federal Reserve can change. Now, in the first Trump administration, Trump didn't get a carte blanche, as it were, from the Senate, and some of his nominees did not get through. But when it comes to trading bonds, interestingly enough, it's not been inflation break-evens that has driven the bond market in recent years. It has been the real yield. And the real yield, for me, is the proxy of the price that has to be paid to keep inflation in check. So you can, in the big picture, you can say the bond market remains relatively comfortable with the idea that inflation is going to be somewhere close to 2% over the next 10 years, and that's a good thing. But it's also saying, and was saying before the debate performance and before late last year, that we may need real yields above 2%. We may need a real Fed funds rate above 2% to keep inflation contained.
Well, I mean, the anecdote in regards to break-evens comes through from various people with real money in the game. They say the Fed only has a problem if the break-evens materially break higher from where we are at the moment. It becomes a little bit more uncomfortable. So just some context around that. Give us your position. I mean, from your notes, it sounds as if I said to you, oh, you're a disinflation bull. You're very bullish on the disinflation. Well, that's a little bit overstating the case. So restrain my enthusiasm.
Well, there was a narrative, and as President Bostic of the Atlanta Fed said last week, he said that some people had said the disinflation progress in the first quarter had stalled out. But that was a poor reading of the data. It was getting too caught up on high-frequency changes in the inflation rate when those numbers, we believe, are distorted by seasonal adjustments that haven't caught up with the price dynamics. So actually, if you just looked at the year-over-years, inflation, the decline in inflation slowed, but did not stop. And the latest reading for May, where core PCE price inflation, that's excluding food and energy, year over year slowed from 2.8% to 2.6%, was a number that really drove home that this decline in inflation remains intact. Now, the key thing for the Fed is to pull off the landing at 2% and not to undershoot. And that's why at some point this year, I actually think the Fed has to cut rates. I think that first rate cut comes in September, because otherwise, as inflation declines and interest rates remain unchanged, real interest rates continue to rise. Right. That makes policy tighter, and that pushes down more on inflation. So the key for the Fed is to communicate, and I think President Bostic took a first step last week, but to communicate that we can cut interest rates, but that's not a real easing of policy, and we are still trying to get inflation down.
And I know you make that distinction by saying this is a 25, 50 basis point tweak. This is not the start of a cutting cycle. I know that's what you see, but my question for you is, rates on the way up, this has been an economy that's been less sensitive to it. So how sensitive is the economy to a tweak, to 25 to 50 basis points? Do we really understand the impact that that will have on what America's economy looks like in 2025, as Lori Calvasina calls it, the fog of 2025?
But the controlling inflation isn't necessarily about controlling the economy. It's not necessarily about trying to slow economic growth. It's about setting the framework where if a price shock comes along, like, for example, a hypothetical tariff, that shock isn't transmitted into the general level of prices. Now, we had those tariff increases in the first Trump administration, and it didn't feed through to a problematic inflation rate. Whereas during the pandemic, import price shocks, supply chain shocks fed into prices that were much broader than the area of the economy that they initially hit. So I think those tweaks are about, in a sense, regulating the inflation rate. And yes, we don't fully know how things work. We don't fully understand how the economy has withstood the degree and speed with which interest rates came up in 2022 and then in 2023, though I suspect it's something to do with the animal spirits and something that when you talk about the Magnificent Seven stocks, that is playing some role in an economy that is right now less sensitive to interest rates.
Do you see any kind of, I've heard various people say there is no mania in stocks. Our own Gina Marston-Adams, she was at the Bloomberg Invest conference last week. It's the strangest things you click on. I clicked on that and it was that very piece. There is no mania in markets relative to the benchmarks that they use. We check NVIDIA pretty much every morning now. We check the Mag 7 every day. Do you feel a sense of mania in equity markets at all? There's a wealth effect, but is there a mania?
Well, the equity market has defied my expectations. And the question is why? How is it that we have been able to raise the discount rate of the market uses to discount future profits so much, and for that to have not had a material impact on the equity market? In fact, quite the reverse. One just would imagine, and it's probably something that keeps the Fed a little bit cautious in thinking about interest rate cuts. You know, what would happen if the Fed were to make a real material move to lower interest rates, not just a tweak? So I don't know whether there's a mania in stocks. I don't know what any individual company is worth, and I don't know how the future of AI and which companies will benefit from it will play out. But right now, one has to say that tried and tested signals of recessions, particularly the inverted yield curve that you made reference to earlier, that inverted in November of 2022 now.
We're almost on the 2-year anniversary.
You know, the average time from a yield curve inversion to a recession is about 13 months. And so you say, here we are, we're
John,
well along.
Can I just jump in there? Because there's been a lot of signals that have been confusing to people. The consumer has been one of them. The yield curve is another part of them. Do we have the right tools right now to analyze this? You talked in the break about the high-frequency data being misleading. Is there something wrong about the data points we're using and thus the Fed is using?
I don't. But the data points being wrong. We have two measures of the economy's gross domestic product, and one actually, from the income side, actually did pretty much touch a recession-like indicator a year ago. But I think the question is, what is it about the dynamic of the economy that is different? And what is different this time is that profit margins at the aggregate level did not get squeezed. And so the question is, how are we pulling off this immaculate disinflation where prices are coming down, the labor market's tight, wage increases remain relatively elevated, though they are slowing, and profits didn't get squeezed? And the answer is we've had a renaissance in productivity growth. And if that continues, then the economy can withstand higher interest rates.
Well, certainly the profits and the margins are there to support in some way that mania or that enthusiasm, if you want to use a more restrained word, in the equity market. Look, great conversation, John. Good to have you with us, and we'll find out whether we're still inverted and having that anniversary party. Maybe come and join us on that day a little bit later in the year. John, right in there of Green Capital. With Danny and myself, breaking down the bond markets. Context matters on Bloomberg. Good morning from a beautiful New York.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Brief, I'm Manus Granny alongside Danny Berger in New York. So the analysts are anticipating a slowdown in the sales number for Tesla. The EV giant is set to reveal its second quarter deliveries in just a few hours. A slump would be the second consecutive quarterly decline, the company's first since 2012. Craig Trudell is with us now. Craig, all the price cuts around the world is not enough to save Tesla for its second consecutive quarter of a slump. Is that what we expect?
Yeah, price elasticity, I guess, is the focus today, and just how much there is left there for Tesla. I think there are some real doubts just based on the numbers that we did see, in the lead up to June. There were real signs of slowdown in China that carried over from the first quarter of the year. Also in Europe, really of bleak results that you saw reported from the industry bodies where Tesla did not have a good first couple of months of the quarter. So, on the last quarterly earnings call, we did hear from Elon Musk say that he thought the second quarter would be much better. I think on a sequential basis, there is an expectation that we will see greater sales from the first relative to the first quarter, but that's kind of par for the course and what you would expect. The first quarter is always seasonally slower for automakers, so I do think that the company will have real questions to answer in terms of what exactly is going on with demand and how soon can they get newer and more affordable models to market.
It feels like sometimes we care about this, Greg, and other times we don't, and we want to live on the Elon Musk dream of robo-taxis and robots. Manus is ready for that world. But it does feel like there's been more analysts coming out and saying this. I talked with Tom Naranyan of RBC last week, who said that the driving force of Tesla's valuation, and for him this makes sense, is robo-taxis. Baird is also out with the note saying that they're all looking to the August 8th robo-taxi unveiling event. So how much does this drive Tesla, especially if we're going to get some weaker numbers coming in?
Yeah, I think it does drive them from a financial perspective and earnings, but it is very important to acknowledge that doesn't necessarily always matter with the retail crowd that is fervently behind Elon Musk, as evidenced by the vote just a couple of weeks back on his pay package. Despite all of the issues that the company has had of late, they remain firmly in his camp, and I think his ability to sell investors on this next dream or dreams is really what it speaks to why the stock has done what it's done. And we saw yesterday Wells Fargo come out with a very bearish note about the outlook for Tesla this quarter, and the stock nevertheless went up 6%, and really for no material reason. I think people are looking ahead to the robo-taxi unveiling in August. But I think it's important to remember and keep in mind that, robo-taxis are something that, this company has talked about going back to 2016, and actually executing them is a whole nother matter.
Yeah, Manus mentioned this to me, that their price target, Wells Fargo, you mentioned it at 120. Tesla currently trading at just under 210. Craig, thank you so much. Bloomberg's Craig Trudell. Okay, let's get you a check now on Paramount shares in the pre-market, up more than 3%, nearly 3.5% this morning. The New York Times has reported that Barry Diller is considering a bid to take control of the company. Joining us for more is Bloomberg's Charlie Wells. Charlie, okay, every single day, every week we come in, and there's still another Paramount story. Someone else trying to make a bid after the whole Skydance debacle. I mean, what about this time? Is this thing real? Are we finally able to stop talking about who's going to buy Paramount?
Danny, this feels like a Hollywood rematch coming to a boardroom near you this summer. Another twist and turn. And look, Barry Diller actually controlled Paramount in the 1970s. He's credited with turning around Paramount Pictures. He tried to bid for the company in the 1990s and actually was failed in that bid by Sumner Redstone, the father of Sherry Redstone. So this is a lot of drama. This is something of a rematch in a lot of ways. What we know is that Diller has signed a non-disclosure agreement with National Amusements. That is the controlling shareholder of Paramount, the parent group of the likes of CBS, of MTV, of Paramount Pictures. Now, non-disclosure agreements are very important in the deal-making process because they allow for the exchange of confidential information. This is according to that New York Times report, but still, the people familiar with the matter who were mentioned in that report did not indicate how far along the deal is. So I can't necessarily answer that question, but we do know that this is yet another turn in this saga.
So the bottom line is, what is Sherry Redstone going to make of this particular bid? How's that going to be received? Because that's the critical key that unlocks the road forward, isn't it?
Absolutely. So this is big franchises, but this is also big personalities. So I mentioned that history of the Redstones, of Sumner Redstone actually outbeating Diller back in the 1990s. And we know that Sherry Redstone fought a long, hard battle to take control of National Amusements. As she attempts to sell this company, it's also going to be a long and hard-fought battle as she tries to offload it. But look, the deal that potentially could emerge here, which would potentially be taking control of National Amusements, as opposed to the sort of merger that was proposed by Skydance just a few weeks ago, that could potentially be a neater transaction, and that could potentially get less shareholder pushback than that Skydance deal.
Fingers crossed, Charlie. Charlie Wells there from the Bloomberg team. Thanks so much. Okay, some other deals news that caught our eye, Manus. I love this. So the Boston Celtics win the NBA title. And then what happens? The owners decide, hey, let's sell high.
Yeah, well, let's face it. They paid, what, $360 million. That was 22 years ago. So this is a moment to just capitalize. And, I mean, there's a real flurry on sports deals at the moment. You've got to say. There might be a frenzy in the bond market, but you know what? There's a real sort of desire to get your hands on trophy assets, excuse the pun.
No, it's true. I mean, he probably has more buyers now. This is Wick Rosebeck, who's the owner who led this club deal in to do it. But I kind of think you get this hint that maybe not everybody wants to sell. Stephen Pagliuca, who's over at Bain Capital, is also an owner in the Boston Celtics. He also is an owner of Atalanta, who's done incredibly well winning the Europa Cup. But he tweeted this, a long tweet, this is part of it, saying that, I hope to be part of the Celtics moving forward and will be a proud participant in the bidding process that has been announced today. But I hope to be a part of the Celtics. That doesn't sound like a man who wants to be gone. But of course, because Rosebeck is the majority holder of this, he can make the decision. The other thing I was thinking, Manus, as a fan, you'd probably be so upset. You'd say, look, this is the winning combination. This is the owners that took us to the big win, and now they're giving it up. Famously, new owners can be really bad for teams.
Yeah, but you can begin to understand what tempts people in. If you just think of some of the media deals that have gone on at the moment and the valuations that are there, and they're in the middle of a mega media deal frenzy, $76 billion of media deals between ESPN, Comcast, and Amazon. So even though you can sort of say it's nostalgic and it's wanting to be involved in sports for the glory of sports and for the winning and for the triumph, $76 billion speaks an awful lot about what's in the game.
Nostalgic, it's the here and now. They just won, Manus.
Yeah, but that's 18 in a row? Sorry, 18th NBA championship, excuse me.
I mean, they're doing really well. I mean, why would you want to give this thing up? I guess for money.
For money.
Oh, he did say that it's for family planning in his state. That's why he was doing it.
How do you spell money? M-O-N-E-Y. Okay, coming up, we've got Jolts. It is Jolts Day. And a little bit more central bank speak for you. That'll be coming from Sintra through the day. Stocks are lower. It's a glorious day in this New York City.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's your Bloomberg Brief. I'm Danny Berger alongside Managed Cranny in New York. Let's get you set for your trading day today. We're going to be hearing from Fed Chair Powell and ECB President Lagarde. They're speaking at the ECB Forum in Central Portugal at 9:30 a.m. Eastern. We're also going to get some economic data. Numbers for job openings come at 10 a.m. Eastern. And then, as we're just discussing with Craig Trudell, Tesla will report its second quarter deliveries before the bell. Manus, I know you're looking at Tesla and some other stocks there.
Yeah, it's down 1.2% with a number of different analysts come out. It had a nice 5-day run, to be fair, so it's giving a little bit back. They were nervous ahead of those numbers. NVIDIA falling following a report. This was yesterday, really. The French antitrust enforcers are preparing to charge the chip maker with antitrust practices. Tesla's down at 1.2%. And then you've got GameStop down 0.7%. That lawsuit accusing popular stocks influencer Roaring Kitty of engaging in pump and dump scheme involving GameStop shares. And it's dropped within days of the filings. That's the state of play on 3 that we're watching. Danny.
Yeah, Manus, let's just get back to that yield curve because we've been talking about it steepening. It has turned to flattening this morning. This gets to this idea of how much can you really trade the Trump trade. Again, we've heard house after house come out and saying it's a steepener, but look, some of it's already starting to dip back, and it's hard to tell on that chart. But how enduring can this really be?
Look, there's a real frenzy. I think when you and I came in, it was, 13 bips over 2 days. A couple of people have been sort of saying to us, look, it really only becomes concerning for the Fed once the break-evens break another 20 to 30 basis points higher than here. I'll leave you with a line, which is this as good as it gets? That's from Mislav Mateshka from JPM.
Well, I like from RBC, Lori Calvasina, it is a fog. Fog for this half of the year and next. Surveillance, take you through the fog next.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We've been anticipating an inflection point in the economy, so you're going to see some flexibility in the data.
We're not at the point yet where things are falling off a cliff, but we're definitely coming off the boil.
If you factor in the Fed policy and how the Fed will have to react to inflationary environment, that could really push growth down.
As far as the Fed is concerned, we should take them at face value. The driver for them has to be really real-time data.
Once bitten, twice shy. Most likely, I think they're going to be a bit late and a bit behind the curve here.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance starts right now, live from New York City this morning. Good morning for our audience worldwide. Your equity market negative by 0.4% on the S&P 500. Kicking off Q3, polishing off the playbooks for the election in 2024. Just take a listen to some of this. BMO, politically provoked. Barclays, buy inflation protection. New Edge. The risk is that yields move higher from here, and yields have moved higher. In just 2 trading days, we've had a 17 basis point move on a 10-year.
And the focus really is on the 10-year, not on short-term rates, and this is important. Yesterday, we saw the biggest curve steepening, the biggest widening out between 10-year yields and 2-year yields going back to the beginning of the year. Raises a question, what can do well in this type of environment? The answer, nothing, except for the dollar. So people are looking at what is the playbook beyond this, if it is something that could potentially become protracted.
Beyond this, beyond bonds, we've got to talk about stocks as well. Laurie Cavacina of RBC out with a new price target for 2024, 5,700, the previous one 53. She calls it a nervous raise, and this is what she says about 2025. Take a listen to this. We think there's too much fog in the 2025 outlook to release an official 2025 price target now. We've been talking about this for a while. Flying blind into 25.
And she's the one that said it's like staring into the sun at a time when potentially fiscal policy could make a big difference. Yesterday we were talking about why there was such a reaction in the bond market. It wasn't because of the potential of just Trump winning the presidency. It was the idea of a Republican sweep. The idea that if one house, one party dominates either side of the government, that's going to be a big problem because there is no deficit reduction in sight. And the more you have actual unity to get stuff through, the more this deficit is going to increase. And it's not really going to be in sight in terms of ratcheting it back.
Right on cue, perfect timing. Chairman Powell's got to speak a little bit later. 9:30 Eastern time. Then we'll get some jobs data for you. Sort of the first sniff of jobs data for the week is the JOLTS job openings report. That comes at 10 a.m. Eastern time. Here's some of the reviews out on the jobs market right now. This from Citi's Andrew Hoddenhorst. The unemployment rate is on the edge of uncomfortable. Just how uncomfortable are things becoming for this Federal Reserve?
So right now we heard from Austin Goolsbee earlier this morning from Sintra, Chicago Fed president, and he basically was saying that we are on a path to 2%. If inflation falls back, that the Fed should automatically cut because by keeping rates where they are tightening. Why is he saying that? It is not because of inflation. Some people might argue, yes, it's because of inflation. It's because there are signs that perhaps the labor market is normalizing, and it never normalizes in a straight line. If you take a look at JOLTS, it's expected to come back down to the levels that we saw pre-pandemic. This is actually a point where suddenly the job openings aren't outstripping all of the unemployed people to such a degree that people can just say, this is a very, very tight labor market. It has changed.
Sintra Portugal is a perfect forum for this conversation to take place. So Chairman Powell will be alongside the ECB President, Christine Lagarde. You and I are talking about economic data. We're having a discussion about rate differentials. Maybe we should be talking about political differentials. This is what Kit Jukes of SocGen's got to say on this. Relative ECB Fed expectations are shifting marginally in favour of the euro, but the political backdrop on both sides of the Atlantic favours the dollar. It's the political backdrop here, the US versus Europe, that seems to matter more to people like Kit Jukes of SocGen than maybe rate differentials, what the ECB or Federal Reserve might do through to year end.
That's what we've seen over the past couple of weeks. It's been basically stagnant on the euro pair, euro dollar, and suddenly it crashed below 107 briefly. It clawed its way back in the face of political instability in the US. The why is interesting here. And coming out of a lot of the discussions that we've had, the why is that any type of tariffs will actually benefit the U.S. dollar, at least in the short run. And that any kind of sort of nationalistic tone in the U.S. will help the U.S. assets more than, say, if there was a nationalistic tone coming out of euro. Why? It is because of the reserve currency. It is because of the dominant position of the United States. Question is how long this can last. We can get into that, but for now, that seems to be the ramifications.
See that dollar strength on a screen right now. Euro dollar 107.11. We're negative by about 1/4%. For the broader price action, your equity market shaping up as follows on the S&P 500. This morning, we pulled back on the S&P by about 0.4%. Some stability in the bond market after the sell-off for the previous 2 days. The 10-year at 445.73. Coming up this hour, we'll catch up with Joe Quinlan of Maryland Bank of America Private Bank on election risk in U.S. markets. Jeanette Lowe of Strategas following the Supreme Court's ruling on Trump. And Claudia Sam of New Century Advisors ahead of comments from Fed Chair Jay Powell. We begin with our top story, investors mapping out growing odds of a second Trump term. Joe Quinlan of Maryland Bank of America Private Bank writing this. The key variable to watch is the US dollar. Will foreigners vote with their wallet per the US election, owning 28% of marketable treasuries, 32% of the corporate bond market, and 20% of US equities? Joe joins us now for more. Joe, let's talk about this. Your reaction to what happened on Thursday night and what you think it means for this market.
Well, John, post Thursday night, I was watching the dollar very carefully over in Asia and Europe, and really no sell-off here related to any political unrest here in the United States or uncertainty. You know, you were just talking, you and Lisa, about the dollar. It's what the dollar has strength. I'm surprised it's not stronger because what's behind the dollar is the great U.S. economy, the private sector, the most productive economy out there. And when I talk to foreign sovereign wealth funds or family offices around the world, they want to own U.S. assets, and there's a preference and a premium on owning U.S. securities. I don't think that's going to change between now and the election. Some uncertainty, but no big change.
Joe, let's talk about what would happen on a Trump win. Got to go through a couple of steps here, but for the sake of scenario analysis, let's say he gets a win. Let's even go one step further. Let's say we get that red wave. I'm thinking back to 2016. A lot of people are thinking about the Trump playbook of that time, and this bond market was demanding bond issuance. In fact, the economic backdrop demanded fiscal stimulus. That's not where we're at in 2024. And if you think about the trades that worked back then, yes, yields climbed, yes, the dollar rallied, but small caps that month in November 2016 rallied by 11%. Joe, I'm just wondering if that's the trade this time around, because that's not what I see in small caps in the last 24 hours.
I mean, the small caps are still in purgatory here. John, you could be right in the sense that if you got an administration that's bent on doing things here in the United States, tariffs, anti-immigration, we're going to have to raise the bar. We're going to have to increase our production across the board, not just large cap, small cap. So it could spread, but to me, it'd be for all the wrong reasons. Nationalism, protectionism. So I think that trade it could come back, but to me, it doesn't give me any comfort because I think small caps can come back on their own, but if it's through policy protectionism, that's a different animal altogether. But I understand exactly where you're going, and small caps will have their day, I think, under a Republican sweep.
Joe, I'm wondering how far out you can actually make some sort of prediction. We were talking earlier, John raised Lori Calvasina and talking about how there just is no visibility around 2025. Do you feel the same way?
No, actually I don't, Lisa. I think 2025, yes, the policy backdrop becomes a little more uncertain. But when you step back, look at the AI revolution, the productivity that's coming, look at the U.S. economy in general relative to the rest of the world, look at the geopolitics. There's places put money to work. There's a premium on resources. The infrastructure build is going to continue. So there's policy fog, but I think there's opportunities to put money to work in certain sectors that, irregardless, it doesn't matter what's happening with politics, it's going to continue into the second half of this decade.
A lot of people were worried about valuations, particularly in some of the areas that you mentioned, AI in particular, looking at NVIDIA's some kind of 140% gain so far this year. You're seeing it kind of trade range bound over the past few trading sessions. Do you agree that it is concerning where valuations are, that there should be some sort of retracement before you feel comfortable really doubling down on those names?
I mean, to a degree, Lisa, yes, we're getting a little, there's a lot of bullish sentiment in the market, so we're careful about that, putting new money to work. But these companies are backing up these valuation with earnings growth, and we see that continuing. Is that going to continue into 2025? Probably not. Year-over-year comps are going to come down, but we're still comfortable owning this market, broadening out. We like the cyclicals. We still like energy. I like commodities. Anything related to transportation and distribution, transmission, we like that space as well. So we're very bullish on defense spending, given where we are. So yes, there's parts of the market that could be allegedly overvalued, but this is backed up by a strong economy, good earnings, good consumption, and foreign demand coming back to you for U.S. securities.
Joe, build on that. Energy, defense. Is there some connection there between the two?
Absolutely, John, because what's the premium? United States is energy independent, relatively speaking, but certainly relative to Europe and Asia. So you got all this demand for AI, the data centers. There's only one country really that can feed this beast, right? This AI beast in a relative way, and that's the United States, because we're energy independent. People haven't made the connection. If you want to drive data, drive AI, you need energy. Who has the energy? The United States. We're going to pull ahead because of our energy independence driving AI, artificial intelligence. We're going to pull ahead of the rest of the world. And that's what the bet people are making when they buy the U.S. relative to the rest of the world.
Joe, let's go one step. What am I buying then? Utilities, energy providers? Is it the oil producers, energy services? Where am I going for that trade?
Our equity analysts like the whole spectrum, John, but also transmission, distribution, utilities, really across the spectrum. We like renewables as well in this space. The interconnection queue, people don't talk about that. We've got to get that better. We've got to be able to take all this renewable capacity and plug it in. It's that simple, and we're missing it. So I think that's coming down the pipeline. More infrastructure on just basic transmission wires, distribution, getting this out. And I think that's a whole new ball game for U.S. competitiveness.
I want to be at the Independence Day celebration at your house, Joe. It seems like it's going to be exciting. I do think that there is a question when you talk about energy, particularly on a day like today where you do see oil prices climbing to the highest levels going back to April. And this is on the heels of both the Hurricane Beryl that's going, the first one on records going back to the 1800s that really has reached that Category 5 level. How concerned are you about a potential spike in prices over the summer if there is some sort of hurricane season that is as violent as some people are worried about?
Well, listen, I would say to be short term, the spike up in prices, because there's plenty of oil out there globally, not just here in the United States as well. So yes, that's a concern. But to me, longer term is everything we just talked about. It's the demand for electricity, EVs, data centers. So we're watching the hurricane season. In particular, when it comes to insurance companies, what does it mean to get insurance and for housing and these other businesses that we've been talking about? That's a big issue. Buyers, the climate change, the climate mitigation is broadening out for insurance companies. It's broadening out. It's going to affect more consumers. I think that's going to be a bigger issue in the second half of this decade that we're going to be talking about.
Brent, back in the high 80s, 87. Joe, it's good to hear from you. Joe Quinlan there of Maryland Bank of America Private Bank. Key theme for Joe, preference for hard power, defense, hard assets, commodities, hard hats, infrastructure. What do you make of that?
That it's a nationalistic kind of agenda. We're talking about increasing defense spending, military, talking about building out your own industry. He's betting on what we've been hearing from every politician. It doesn't matter which side of the aisle they're on. And this, frankly, he's not alone.
It's a big, big theme at the moment. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg Brief and Danny Berger. Hey, Danny.
Hey, John. Headline Eurozone inflation slowed to 2.5% in June, adding to evidence that price pressures are gradually moving towards the ECB's 2% target. However, services inflation was stubbornly stuck at 4.1%. At this week's annual ECB retreat in Sintra, Portugal, Chief Economist Philip Lane said that he still had lingering questions around services inflation, and the data have yet to settle it. ECB President Christine Lagarde, for her part, said that the central bank still needs more time, with the region still facing inflation uncertainties. And the yen is hitting a new 38-year low against the dollar after sell-off in treasuries, trading above 161 per dollar this morning. Now Vanguard is predicting the yen could weaken to 170 if a BOJ decision at the end of the month fails to boost Japanese bond yields. That slide is putting pressure on the central bank to intervene. The head of international rates at Vanguard went on to say in an interview with Bloomberg that a repeat of Japan's yen buying spree in April will do little to slow the currency's tumble. And the Paramount saga continues. IAC Chairman Barry Diller is considering a bid for Paramount, according to the New York Times. Diller, who led Paramount Pictures decades ago and lost a bidding war for the company, is now said to be making an offer for control of its parent company. Paramount, the owner of CBS and MTV, has been weighing options for months and came close to a deal with David Ellison's Skydance Media before the negotiations collapsed. And that's your brief, John.
Got to say, Danny, this is becoming a bit tedious, isn't it? Chase for this company. You felt the same way?
I felt the same way. I was thinking like, oh, just buy it. Just get over it or something. I had the same feeling.
Danny's back in about 30 minutes for an update if we have one for you. Up next on the program, attempting to shift the narrative.
No one is above the law, not even the President of the United States. Today's Supreme Court decision on presidential immunity, that fundamentally changed.
That conversation just around the corner, live from New York City this morning. Good morning.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The second day of Q3, here's the price action for you on the S&P 500, negative here by 0.4% in the bond market, just about unchanged at 445.93. In foreign exchange, the euro a little weaker here, 107.13. Much more on the recent comments from President Lagarde in about 15 minutes' time. Under surveillance this morning, attempting to shift the narrative.
No one is above the law, not even the President of the United States. Today's Supreme Court decision on presidential immunity, that fundamentally changed for all practical purposes. Today's decision almost certainly means that there are virtually no limits on what the president can do.
So here's the latest. President Biden slamming a Supreme Court ruling that could allow Donald Trump to escape prosecution for his role in the January 6th riot on Capitol Hill. Biden's comments coming as his campaign looks to move the narrative away from last week's debate debacle, which saw a growing number of Americans question the president's ability to serve. Joining us now is Jeanette Lowe of Strategas, the Baird Company. Jeanette, I've got to say, you're on the money when it comes to what you're focused on, and that's the tight Senate races that we should all be watching. And if those start to shift, maybe this president's in even more trouble than he already is. Jeanette, what are you seeing in those tight races now?
Yeah, good morning. So, I mean, it's a great point. The big thing that we're seeing coming out of Thursday is that everyone's worried about Biden being at the top of the ticket and now potentially having that debate performance that really did not change the election trajectory the way he wanted it to do. The bigger impact is what's going to happen in these down ballot races. And so one thing that's really important is that you are seeing Democratic senators who are, in general, it is more difficult to actually unseat an incumbent senator. We have Democratic senators in states like Pennsylvania and Wisconsin and Arizona who are actually currently outrunning Biden in the polls. And so I think that if you start to see those numbers really change direction over the course of the next few weeks, right now the Democratic Party is kind of rallying around Biden, saying that they're going to have him remain at the top of the ticket. But if you really start to see deterioration in the polls, deterioration in fundraising, and deterioration in the polling for these down ballot states, that's going to pose a lot more trouble for the Democratic Party come November.
You mentioned three things there: polling, fundraising, down ballot Senate races. Can we talk about fundraising? Some of the numbers that I've been seeing, Jeanette, say there's no problem here whatsoever. What are the numbers that you're looking at?
Right. So right now there is no problem. So they had pretty good numbers over the weekend for the Democratic side. We'll have to see. I think right now, they're definitely concerned that the Republicans are having really good fundraising and kind of eating into the fundraising advantage that Biden did have earlier this year. But right now there is kind of this rallying right around him. You had the president come out and speak last night about the Supreme Court decision. This is really him trying to reframe, maybe try to get some of those images of Thursday night out of the public view and put some new images out there. So him taking that stand last night to make a statement was important for the campaign to try to reset and to try to change the narrative a little bit away from that debate performance and be a little bit more presidential. So I think that we're going to be watching those numbers. Right now, everything does seem to be okay, but I think the next couple of weeks are going to be really critical for this race.
There's some discussion of the DNC, Bloomberg reporting that the Democratic National Convention Committee is thinking of actually pulling forward the nomination of Joe Biden to try to throw a sense of support behind him. Is this the right idea, given the fact that anger is still out there, very much so, and there's a question of why the internal circle around Biden isn't necessarily being more transparent about this process?
Right. And this is something that was actually kind of planned a little bit earlier. They were thinking about doing it before August 7th, just because there had been issues with the Ohio ballot. And so the party wanted to have him basically nominated early, just so that there couldn't be any turmoil at the convention in August. If you have a contentious convention, that generally doesn't bode very well for the party ahead of the actual election. And so that was something that they were actually trying to avoid. But one of the things that they're trying to do now is thinking about, okay, well, if we can actually move this forward, that would kind of solidify Biden as the nominee. You can't have people coming up at the convention trying to throw another candidate's name into the hat. But this is ultimately going to be, for better or for worse, this is down to Biden making the decision whether he wants to stay at the top of the ticket or if he wants to step down. He can do that before the convention. That could be very messy, having multiple delegates having votes to figure out who should be the next nominee. The committee can also do it after the convention as well, or we could see Biden stay in the entire time. But I think this move to potentially have the nomination done in July is a way to try to squash any dissent if Biden can keep his numbers up over the next couple of weeks, we don't see a great deterioration in polling. If we can see him making more statements like last night than last Thursday, I think that would be something that would allow him to stay at the ticket. But this is something definitely to be watching.
Jeanette, yesterday we had a series of guests talking about how Thursday night was a game changer for them in the market, that essentially they were looking at the higher likelihood, much higher likelihood of a Republican sweep, exactly going to your first point, which is essentially you need to watch down ballot and see how many people basically stay home, are not excited about the top of the ticket, don't feel like they're being heard by the Democratic Party. How much is that something that you're seeing as a much greater likelihood today than, say, Thursday morning?
So I'll agree. I think the consensus is that there is definitely a greater chance that we're going to have a Republican sweep in this election. But I do think it is important to not assume that that would be the case. Again, these down ballot races are quite important. What we have kind of seen is that it seems that there's a much bigger problem with Biden and Harris at the top of the ticket rather than an overall problem with the Democratic brand. So you do see House races that have done quite well. You do also see these Senate races, again, where the Democratic candidates are outperforming Biden in key swing states. The other thing I think that what's important to watch is we don't want to just watch just what the polls say. We want to see actual results. So we've been watching the special elections that have occurred since January, and Democrats have been outperforming by 11 percentage points versus what happened in those districts in the last election. So that does seem to indicate that there could be some ticket splitting this year. It could be that voters might think that they could vote for maybe Trump at the top of the ticket, but then Democrats either in the House or the Senate races. The important thing to remember is that currently Congress has very tight majorities in both the House and the Senate. It will not take a lot of seats one way or the other to really move that, but there is still the possibility that maybe we don't see a Republican sweep. Maybe we actually see a divided Congress next year.
Jeanette, you get the distinct sense right now that a lot of people in this country feel like they're being lied to. Like there's a division emerging between the campaign and the rest of this country. And I don't know what this campaign does about that. If I think about some of the stories over the weekend, we saw even CNN getting blamed for the makeup they used on Joe Biden as if that was the problem on Thursday night. What do you think they're going to do over the next 4 months to try and right course what we've been seeing, not just on Thursday night, but for the last 12 months?
Right. And so, I mean, I think that Thursday's debate definitely reinforced voters' concerns about Biden's age, about his fitness to continue to serve as the president. And the president really needs to try to change this race. It is currently a referendum on his first term in office. His approval rating is hovering around 40%. That is not good if you're looking to get reelected. So he really does need to change this into a choice. There are some key factors to look for in the coming days. Obviously, with the Supreme Court decision yesterday, you saw Biden's statement to try to change this, to try to say, okay, that was the decision, but I'm going to try to frame this as more of a choice between me and former President Trump. You also have Trump's sentencing coming up next week, so that's going to be an important point. Things also to watch for is who is the vice presidential pick on the Republican ticket. So there are options for the Democratic Party to try to reframe the race, to make it just more of a choice between Trump and Biden. But there already is kind of this baked-in feeling that voters have been concerned about Biden's age. Yep. That wasn't alleviated over the course of the last week, and that's something that they're going to have to figure out how to deal with.
Jeanette, this was great. Jeanette Lowe of Strategas, thank you. Up next on this program, global central bankers meeting in Sintra as political uncertainty weighs on markets.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Stocks just a little bit softer here. We're down by 0.4% on the S&P 500. Looking at the NASDAQ and the S&P, both negative by 0.5%. On the Russell, we're down by about 0.4%. The attention really on the bond market in the last 24 hours, include Friday and that, the last 48 hours of trading. The 2-year has been really, really quiet. The noise is at the long end of the curve. The 10-year yield repricing higher to 4.4554. And Lisa, just pricing in the odds, the higher odds of a Trump win. More debt supply, higher tariffs, the threat of higher inflation too.
And not just a Trump win, but a sweep. And that is what we heard from David Kelly. That is what we heard from a host of different guests yesterday who came on and said right now, exactly to Jeanette Lowe's point, watch down ballot. There are going to be potentially independents who stay home, who don't want to go to the ballot. So at this point, can you start pricing in some sort of yield premium? Is this sort of a mini bond market tantrum that's sort of giving you a sense of what's to come? Or is this a blip as people try to look for an edge in a relatively edgeless world?
So we get these high yields and it makes it even harder, I think, to construct an argument that the dollar's about to break down anytime soon. If you switch at the board and turn the page to the FX market, that means there's a problem in Japan. Dollar yen at 161.66. The higher the session, 161.74. We'll talk more about Japan in just a moment. And over in Europe, we've got the euro at 107.17, negative by 0.2%. So we've got dollar strength across the board, through G10, including the Japanese yen. And even when we start to talk about rates, Christine Lagarde of the ECB is opening up Sintra Portugal, their big ECB forum, talking down rate cuts in 2024, talking down rate cuts for this month at least, for the month of July. It's not doing much to buy much in the euro, is it?
No, especially at a time when we see the Eurozone inflation come down pretty much in line to 2.5% in June. That's basically getting closer to that target. You have some discussion from other ECB officials saying, well, I'm not ready to call out any kind of additional rate cuts. She's trying to have a more hawkish message. The market is saying, frankly, it doesn't really matter because if you look at the politics in your region, the politics in the United States, the strength in the United States versus the weakness that we're seeing in parts of the euro, we're not buying it.
Isn't it funny how it adds up, though? We talk about political risk in France, higher debt issuance, not doing things about the deficit, yields are up, spreads are wider. That's a euro problem. We talk about almost exactly the same thing taking place in the United States. That's a euro problem. It's like the dollar wins, either way.
And this sort of goes to this question that you've been asking for the past, 6 months. At what point does the U.S. lose the privilege of acting recklessly in terms of borrowing? And the answer is not yet, and probably not in the future, because what is going to replace it at a time where there is this engine of innovation in AI, in technology, and that's what a lot of people keep pointing to.
Not the euro, that's for sure. 107.17 on euro dollar. Under surveillance this morning, President Biden slamming a Supreme Court ruling that found Donald Trump has substantial immunity from criminal prosecution for actions taken while in office. Biden's televised remarks coming as his campaign looks to shift attention away from last week's debate debacle. And they're struggling to do just that, Lisa. And if anything, if you're in the market right now, you might believe that the decision that came out yesterday morning just feeds even more life, breathes even more life into this campaign of Donald Trump this year.
Because it's unlikely that he's actually going to be put on trial for some of the other existing trials. before the election. So at this point, that's not going to be as much of a distraction as maybe Joe Biden would like. Look, there is a bigger question, and it's something that I have felt pretty consistently over the past few months, which is the trials and the legal issues that Donald Trump has faced haven't really moved the needle. It's not what people are paying attention to, and it hasn't been for quite a while. The people who are going to care and not vote for him as a result are not going to vote for him as a result, and the people who don't care aren't going to care, period, full stop. So the question here is, how do we sort of look at this election at a time where Joe Biden is facing increasing calls from his own party, and Donald Trump is suddenly remaining quiet because he can let the other party implode. And that's what you're seeing happen, even as there's some real questions about the legality of Donald Trump and some of the things that he did. So you could talk about the Supreme Court, and you're going to hear a lot of noise around that because there's anger around the split decision. At the same time, you wonder whether that really does anything to fundamentally shift the race.
I'll agree with you by disagreeing with you. It has moved the dial. It has moved the needle, but it's helped him. It hasn't hurt him. Hasn't it, over the last 12 months? If anything, you know, I remember the polls for the Republican primary that had the governor of Florida, DeSantis, ahead of Donald Trump by quite a margin. Do you remember those polls?
I do remember those.
Yeah, do you remember why they changed? Because all of a sudden, Donald Trump is back in the news flow, in the news cycle in a massive way because of these criminal investigations. He takes on this sort of martyrdom in the Republican Party. And this has really helped him. It hasn't hurt him. And still, look, here we are sitting here. If anything, Joe Biden would love, the sitting president would love to make this a referendum on the former president. His struggle after Thursday night is becoming a referendum on him, and he can't get away from that, Lisa. And how he changes that over the next 4 months, let's see.
The problem is, and you nailed it, when you said ultimately this comes down to a feeling of honesty and whether people feel like there is a transparency. This from the Financial Times, from a Democratic operative who has been in the market for a long time. There seems to be a level of anger, and this is within the Democratic Party, that the inner circle has been keeping things from all of us. This is the issue. You can't turn the page on a fundamental feeling of distrust, and that has to be addressed directly, and if it's not, you're going to have these existential questions heading into November.
Forgive me for playing political pundit on TV for another 2 minutes. Political elitism does not work in global politics. This is where the party went wrong in 2016 with Hillary Clinton, failed. Joe Biden sees himself as Scranton Joe, you know, sort of scrappy, working class, blue collar politician, and we've got to sit here and ignore the fact that he's been doing this for 4 decades. And the fact that the behavior of the last couple of days just screams elitism. It's political elitism to sit here and say, don't believe your lying guys. What you saw on Thursday night is not what happened. And to have people come up, including a former president, say, yeah, you can have bad debates, you can bounce back from them. You can't compare what happened Thursday night to a bad debate of Obama against Mitt Romney. That's not what happened Thursday night. It's not like they got their lines wrong. That's not what happened on Thursday night at all.
Well said. And this is what we saw at G7, and this is what we're seeing globally. There is this issue of trust us and outrage that people are saying, wait a second, hear what we're saying. And that, I think, needs to be reflected.
Without a doubt. Much more, of course, on this throughout the morning. Let's turn to the Japanese yen. Traders paying very close attention to possible yen intervention as the currency touches a 38-year low against the dollar following a jump in US Treasury yields. Japan's vice finance minister saying recent moves in the currency are largely driven by, guess what, speculative trading. Those comments not helping. 161.68.
Especially at a time where you have some banks, including Bank of America, calling for the potential for yen to get to 170 versus the dollar. That's the kind of level that you could see. Or Vanguard sees the yen sliding that kind of level. If you see this ongoing lack of response from the Bank of Japan, ultimately it requires a rate hike in order to get some sort of traction underneath the yen. And in the meantime, U.S. travelers who want to go to Japan can get an incredible box of sushi, evidently, for, $12. That's what I'm hearing.
Is that the feedback you're getting?
That's the feedback.
From your tourist on the ground?
Yeah, I'm getting from color on the ground.
Amazing. 161.68 on dollar yen. Let's turn to the global central bankers meeting in Sintra, Portugal this week. We'll hear from Fed Chair Jay Powell alongside the ECB President Christine Lagarde at 9:30 Eastern Time. The meeting coming as elections in France and the UK, as well as the upcoming US election, continue to weigh on global markets. Bloomberg's Enda Curran joins us now for more. Enda, great to catch up with you, sir. What is the overarching message coming from these central bankers in Sintra, Portugal?
I mean, there's so much uncertainty, John. I think on the one hand, they want to talk about inflation. They want to give guidance about where rates might go from here. And in truth, probably most central bankers would like to cut interest rates if they could right now. But take the UK and France. We have two massive economies this week with major elections due. France, of course, so much uncertainty in terms of whether or not there's a hung parliament there or a majority for the RN. That will dictate fiscal policy that will dictate relations with the rest of the EU, and of course that's so critical for the broader ECB story. And it's the same in the UK. Broadly, a result expected to return a centrist Labour government, but still question marks over the growth and spending story there. So, you know, in many ways, no matter what the central bankers say today, they know in their heart of hearts that their political masters back home are busy, and whatever way those votes turn out will dictate macroeconomic policy in the months ahead.
Which is the reason why we're dealing with the S word again: sufficient, sufficiently restrictive, sufficient data. That's what we heard from Christine Lagarde. We are still facing several uncertainties. It will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed. We saw the Eurozone inflation rate come down to 2.5% in June, pretty much getting closer to target as expected in that region. I'm just wondering whether you're getting a better sense from the central discussions around what sufficient data means, about what data people are honing in on. Is it really just the labor market at this point, as people assess the turn in inflation and now potentially the long and variable lags?
I think there is a lot of focus on the jobs markets, especially in the advanced economy world, Lisa. We know in the US, for example, people here like Goldman Sachs talking about the inflection point in the labour market. We'll get more, of course, we'll get jobs out on Friday. That will decide whether or not that is the case. Similar in Europe, a lot of focus on the jobs market, but also there's a lot of concern about policy error. The risk of moving too soon, the cardinal sin for central bankers. And look at Canada. There's been some focus on Canada among the analyst community in recent weeks. They were the first G7 central bank to cut rates, but then they had an upside surprise in inflation. A lot of people saying that's exactly why the Fed are being as cautious as they are, and of course why the ECB is trying to contain the narrative and control the market horses too when it comes to interest rates. But I think the whole backstory is, though, that most central bankers would probably say growth is slowing. They would like to be in a position where they can bring down interest rates. It's just that there are so many sticky pockets, especially in the services side of things, that's keeping inflation, perhaps just a little bit too high above their inflation targets. That's holding off any kind of near-term rate cuts. And I think that's why we've been